and we didn't have the Russian invasion of Ukraine, so we removed these big supply shocks, US rates would have been drifting higher already, this neutral rate. Just as we solved and escaped that weird funk after the post-financial crisis period, the Fed had already started to react to this change from 2017 onwards, but then had to adjust rates downwards because of these two huge shocks. And so neutral rates have drifted higher. And so you can ask the question, I know this side of the pond you like to refer to R star, so let's go with that. R star is maybe 4%, maybe even a little higher, which means we only have 100, 150 basis points of tightening, not 500 basis points of tightening, which is why inflation expectations have only come down a bit, why the housing market has corrected but consumers haven't completely panicked, and why the jobs market has slowed rather than fallen off a cliff.
You've teed up an obvious question. Are we sufficiently restrictive based on that? Because the Federal Reserve seems to have a very different view on where neutral is.
Well, I think we're going to find out where neutral is. I think it's hard to be very precise at this moment. I fear more killing inflation rather than allowing the economy to run a little bit hot. Because remember, our markets are not really systems, they're adaptations, and they adapt through prices. And so a world where prices grow at 1% is not sending you a strong signal about investing here, investing there, hiring here, firing there. The moment you have 3% price growth, suddenly you have strong signals to do something. Those signals are necessary. And so I would prefer to say, let's run the economy a little bit hot for a while and let this renormalization just take place, than risk killing the upswing and going back to a 1% inflation.
A lot of should versus will. Can we just clear that up? I know what you think they should do. What do you think they will do this year?
I think June is going to be a massive month for markets. I think the Bank of England, the Fed, and the ECB are probably all going to cut rates, and then it's a question of how far they go. Base case would be 4 for the US. I think 4.5 you can get to, and then there's a question of whether or not they can go 50 more next year. Base case would be, but I think it's a close call.
Bramo, with the face.
Well, 4, I mean, it just seems like if things are surprising to the upside in terms of economic growth, why would they cut more than they're saying now?
We were, second half of last year, US around 4% annualized. That's probably twice the rate of potential growth. This first half, we're probably going to slow to slightly below 2% annualized. Inflation is probably going to come down a little bit. And so the Fed will probably get an opportunity in Q2 to start cutting interest rates. Then, well, you just have this institutional momentum. You'll cut a few times in a row. And then in the second half of the year, let's see if inflation expectations and inflation starts to creep up as the economy starts to reaccelerate. And then you'll ask the question, when can the Fed stop?
Got it. We've said it a few times, haven't we? We need the Bramo cam. You just need to see Bramo's reaction as guest speaking. Just to know what...
probably would check me, and I'd have to actually pay attention.
What Lisa really thinks about stuff.
Hey.
Callum, it's good to see you. We live in New York. Thank you, buddy. Berenberg's Callum Bickering there. Coming up on this programme, Avery Sheffield of Vantage Rock, Megan Robson of BNP Paribas, Bloomberg's Mario Parker, and Javier Blas on Guess What? We'll talk a little bit of oil, but Bramo demanded it. A chocolate conversation with Javier Blas.
Everybody wants to know.
Okay, cool. That's coming up next.
Chocolate.
It's coming up
ahead
next.
of Easter.
They're coming after it.
It's going to be expensive.
They're coming after it.
Who's that?
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. there are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
Breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Rates market are moving closer to where we think things should be, which is around 3 cuts.
There is certainly a lot of risk that the Fed waits a little bit longer. They're likely to err on the side of caution.
The big disconnect at this point still is that once we start cutting, we're going to cut aggressively towards a normalized world.
The Fed is more likely to simply remain on the sidelines rather than re-engaging in further rate hikes.
I think it's becoming increasingly likely that maybe we have no rate cuts this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This story has changed so much in the last 2 months. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance begins right now. Your equity market on the S&P 500 almost totally unchanged. Just to wrap up the data in February, starts with a blowout jobs report. CPI, upside surprise. PPI, upside surprise. PCE comes in line. And this is what Evercore's Krishna Guha's got to say. No new, bad news. And ultimately, that's what this market traded on yesterday.
Everyone's looking for the tail risks. That's why I have a list of worries, and it's getting shorter, but I can add some things. There are some issues, though, with this idea of can we get continued growth and upside surprise without commensurate inflation? There was a hot second. People were worried. Maybe it was picking up again. PCE wasn't surprising, and everyone went back to their Goldilocks nirvana.
And the stocks look good. Stocks just had the best months.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
The stock market. Well, I keep going back to people having a sort of out west view of the Fed and the ECB. They're locked and loaded and ready to go, and boom, 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 they can, respond to any weakness with cutting rates, and that's the big hope. But to me, it's just unclear whether we can get growth without inflation, whether the AI boom is going to.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Let's talk about those downside risks.
Exactly.
Welcome to the show. What are they? How long is that list?
Yes, yes. Well, I think the risk is really in terms of what's already been priced in, right? So as you've been speaking about, we're running a 6 to 7% fiscal deficit in that type of environment. It's really hard to see much economic downside absent some geopolitical risk or conflagration of something happening in the banking sector, which we're not predicting. And so the economy looks like it is humming along. It's okay, but from a stock perspective, what's priced in, right, with the NASDAQ at 29 times, with S&P, nearly 21 times, with real rates, the highest they've been since the GFC, like, there's a lot priced in, and so I think what it means is that when expectations aren't met, the downside can be very meaningful. But we would say it's probably more likely to happen on a stock-specific basis rather than for the market as a whole, given, again, the very generous spending from our federal government.
I remember you said something about Chairman Powell last time we spoke, something along the lines that his ultimate goal wasn't price stability, it's to make people happy. Yes,
exactly.
Is that still your description of Chairman Powell?
Yes, well, I think he was listening because since then, right, in the January Fed meeting, he did come out and even say explicitly, which I think was, it was a little refreshing that, wow, inflation actually looks like maybe it's picking up a bit and we're not going to likely to raise in March. And you've had Waller out there, even Mary Daly, this week on Bloomberg saying that consumers are concerned about inflation. It's one of their top risks. And so we can't really we can't really lower rates to continue to stimulate the party in the way that it suggested that he might from his comments in December.
So this was something that I thought was interesting. He said all the right things to make people happy, but he didn't really address the issue of financial conditions easing and what that would do to really push them further away from their goal.
Yes.
Do you think that that's because it's no longer relevant, or do you think that it's because they're just not aware of how much the incredible easing in financial conditions has really made it more difficult for them to conquer inflation?
Right. Well, I think at that moment in time, he just didn't want to stop the party, to be quite honest. I mean, it was so clear that financial conditions had eased so much, but he was probably hoping that inflation wouldn't reaccelerate for a while and he would have some leeway to begin cutting sooner rather than later to keep everything on kind of a steady course. But because inflation has reaccelerated, because it's still so prominent in consumers' minds, now the easing of financial conditions is flowing through, I think, so quickly that they've had to walk back kind of this more, financial conditions don't matter, we're just going to do what we're going to do. But they're flowing through, and so they're having to respond to it. And to your point you've been making, Lisa, can you really ease without reaccelerating inflation? And so many stocks right now are priced as if the Fed is going to ease and that is going to stimulate demand from the current level, rather than that the Fed would only ease in response to actually things getting a bit worse.
So this morning I walked in and I said, everyone's talking about this partying as if it's a negative. What if it's a positive? What if there's nothing wrong with this party? Because we have a lot of cash in the sidelines. We've got just as much money going into cash funds as you do, actually more than you do having going into equities. Is this healthy?
Well, the issue is that it's leading to continued inflation, which consumers aren't happy with. If consumers were happy with inflation, if they were happy with their chocolate prices, if they were happy with their Happy Meal prices, if they were happy with the cost of housing, it wouldn't matter. But consumers aren't happy. And so that's where we have this issue that you can't just keep stimulating the party and have people actually be happy.
But we see a divergence in consumers, and you talk about this in your notes, a tale of two cities.
Yes.
get into that with us, because not all consumers are not spending.
Right. So the high end clearly is continuing to spend. It's really the low end, well, they're continuing to spend, but they're not happy with where they're spending, right? Too much on chocolate, too much on coffee, not enough money left for discretionary. But those higher end consumers are continuing to spend. And I think this is one of the issues that we're facing, is that if everyone wasn't spending, it would probably lead to deflation. But enough people out there are spending that it creates inflationary pressure for everyone. And so it makes, the Fed's tools are very blunt of lowering rates, right? It stimulates demand for everyone, and the low-income consumer gets hit more. And so I think that's a real issue. And we do think that is going to keep the Fed more in check for longer. And it means that these stocks, especially in the consumer sector and other sectors, that are being priced for a Fed cut, stimulating demand from these levels, are unlikely to live up to those expectations.
That's the third time you've alluded to this, so I can't let you escape without giving us more detail. The risk at the single name level.
Yes.
What are these names? What are these companies?
So I prefer not to speak about single names, but I'll just speak out about more generally what we're seeing. So when you have, like, in areas of the economy, so in the consumer sector, you have stocks priced at 30 times, 40 times earnings that have been real leaders, that have been brands that people have loved for a long period of time, that are facing increasing competition, that were benefited from lower income consumers or middle income consumers trading up, that are not reflecting those risks. So, like, that's where I look in the consumer sector for more downside risk. Also, companies that sell furniture, home improvement, everyone's pricing in these cuts, re-stimulating demand. And I think the demand might fall further before it comes up. Then you look at the software sector. In software, I mean, we've seen this week, right, very different results from different software companies that are priced for perfection and maybe benefit from AI, but not as much as people think. We're already seeing those kinds of stocks really correct, and I think we'll continue to see this kind of rolling bubbles deflate, while companies out there that don't have that bubble-like dynamic, that benefit from an economy that's rolling along, actually have some opportunity to the upside. I'm not saying everything's going down.
Given the names that you've just cited there, though, you didn't do them specifically, but I can say them for you, maybe sort of like Depot Homes and Throws, like those kind of companies, rhymes with. Did I do that right? You love doing that. Thank you. Thank you.
Wow, that's good.
Right, thank you. How insulated will the index be, given their very small weighting on the S&P anyway?
Yes. So for the S&P as a whole, and I was speaking specifically about those types of companies, but for the S&P as a whole, right, you have kind of your Magnificent Seven. The performance of the Magnificent Seven has really diverged underneath the surface. I think it's emblematic of what we're going to see in the market as a whole. And so will 4 of those names that have done the best this year be enough to offset potentially some weakness and, like, 2 others, maybe a little softness in 3 of the others? Like, that is what's probably going to drive things at an index level. But we've already started to see that bifurcation, and the level of valuations that we see within those companies elsewhere suggests, I think it's hard to make a call on the index as a whole.
I love your idea about specific companies. This brings me to French call centers. And I really do think that this actually is one of the most, it actually is really an important story. So this is a company that totally fell out of bed because Klarna said that its AI assistant is doing the equivalent work of 700 call center employees, and had 2.3 million conversations. First of all, anyone having a conversation with a bot, good luck. But I am curious about how many teleperformances there are out there.
Right, there are more, and I do think that is an area, absolutely, where we're going to see almost, AI having more earthquake-type shocks rather than AI being a rising tide that lifts all boats. So we are certainly, as we look at companies out there, there are these really overvalued companies that won't meet expectations. There are also companies that are likely to be disrupted and don't have it priced in.
Avery Sheffield, thank you. Enjoyed that. Avery Sheffield, Advantage Rob. Morgan Stanley's Mike Wilson talked about this, the difference between AI enablers, NVIDIA, etc., and AI adopters. And I think the second piece of this is the piece that you're alluding to, how this is actually going to play out in practice and which companies will take it on and succeed and others which might struggle and fail.
I love this story, and it's hard to talk about in generalities, but there are certain companies that are going to do much better with respect to productivity, and then there are going to be those that in 2 weeks are going to be called out of business because basically their entire business model is getting disrupted. That's fascinating. And that, to me, that kind of under-the-hood work that doesn't really lend itself to morning TV is really interesting.
I'm interested too, and I think it does lend itself to morning TV. How labour-intensive, how labour-light will some of those companies be? And what are the job losses going to look like? Where will those job losses be? In the West, you're going to find them over in Asia, in places like India, where a lot of those call centres moved to at certain institutions over the last few years.
It's a great point in terms of cheap labor and where it gets blown out in particular and how that affects different economies. I would also argue in the U.S., there are something like more than 1 million grocery store cashiers. You think about jobs like this that are the rank and file. What happens to all of those jobs down the line?
Cheap labour, chatbots. That is the issue.
Yeah.
Big issue. Equity futures right now on the S&P, negative 0.1%. Lisa just makes it feel so small when she talks about French call centres being on this list of worries. But I'm with you. I'm with you. You need your weekend, don't you? I know you do.
Amen.
Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Eurozone inflation eased less than forecast in February. It backs the more cautious ECB officials. Consumer prices rose 2.6% year over year, slightly above estimates. The ECB meets next week. President Biden will push plans to increase taxes on corporations and the wealthy and lower prescription drug prices in his State of the Union address. He plans to lay out his economic agenda for a potential second term in office during the State of the Union Thursday evening. Treasury Secretary Janet Yellen says any plan to seize Russian assets cannot be seen as a replacement for Ukraine aid. Aid has been held up in Congress as the country's war with Russia enters a third year. She's speaking with Bloomberg and said the EU has offered Ukraine, quote, very meaningful financial, but the total just doesn't seem like enough. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the programme, a battle at the border.
This is a Joe Biden invasion. This is a Biden invasion. It's a military operation. I mean, we have this is like a war.
So here's what I would say to Mr. Trump. Join me, or I'll join you in telling the Congress to pass this bipartisan border security bill.
We'll head down to Washington, D.C. for that conversation next. Live from New York. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lines, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg, context changes everything.
2 hours, 12 minutes away from the opening bell. Equity futures on the S&P 500 negative here by 0.1%. It yields a little bit lower by a single basis point, 423.65 as we head towards the weekend. Under surveillance this morning, a battle at the border.
This is a Joe Biden invasion. This is a Biden invasion. 3 years ago, we had the most secure border in history. We had the most secure border, and people weren't coming because they knew they weren't going to get in. It's a military operation. I mean, we have this is like a war.
So here's what I would say to Mr. Trump. Instead of playing politics with this issue, instead of telling members of Congress to block this legislation, join me, or I'll join you in telling the Congress to pass this bipartisan border security bill.
Here's the latest today. Donald Trump and President Biden making dueling trips to the US-Mexico border as immigration continues to hold up spending bills in Congress and is a key issue in the run-up to November's presidential election. Bloomberg's Mario Parker joins us now for more. Mario, the rhetoric is far apart. How far apart are they on policy as well?
Oh, it's night and day in terms of the gulf between Trump and Biden on policy. I mean, but to be sure, I mean, recall that Republicans essentially exacted exactly what they wanted out of President Biden in terms of an immigration and border deal, and then they reneged on that deal early in February at the behest of former President Donald Trump, who wanted to keep the border and immigration as a political vulnerability for his opponent as they look ahead to November.
But when it comes to potentially an executive action, Biden would have to use the law 2212F that former President Trump wanted to use. And this would be suspending the entry of these foreigners when it's determined that their arrival is not in the best interest of the country. If he was to go that route, how much pushback is he going to get from the progressive left?
Oh, that's a great question, Emery. I mean, he'd get a lot of pressure from the progressive left. If you kind of see, I mean, he's been vacillating or mulling this for the last 2 or 3 weeks, particularly, as I mentioned, after that deal was scuttled, whether or not he has the executive authority to do something, right, vis-a-vis Donald Trump. Make no mistake about it. You all are in New York. We see some of the pressures that are on Biden's side from Democrats, right, not just the progressives, but centrist Democrats as well. Illinois, New York, some of these big cities that are being inundated with migrants based off of this gambit that Texas Governor Greg Abbott pulled. So Biden's just caught in between a lot of different pieces, both within his party, but then also in the Republican Party. However, the fact that we saw him go to the border was a follow-through of a promise that he said he was going to go out on the road and take this fight head on, try to explain to the American people the politics of what happened here.
Mario, bring up a great point. Tom Suozzi, partially why he won is he talked about the border, and Long Island is a far cry from the southern border. What is Biden going to say, though? He just did this trip, but what is he going to say next week in the State of the Union about the border?
Yeah, well, it's quite unclear just right now what he'll say exactly, other than the fact that he's going to put the onus on Republicans. Again, he's going to point to the fact that he did concede to many of the Republican demands in that deal that they scuttled earlier this month, and that they've got essentially, he's going to cast Donald Trump as a puppet master over the Republican Party. The gambit on the other side, of course, is that Republicans feel as though it's just so entrenched of an issue for Biden that he won't be able to dig himself out of a hole. Now, in terms of the State of the Union address next week, Biden's campaign is casting that as his vision for America, his outlook, essentially another seminal moment in this presidential campaign. It happens 2 days after Super Tuesday. They want him to start having a vision looking forward and communicating that to voters, while also trying to explain to voters some of his key legislative accomplishments have improved their lives.
Is there any evidence that what Biden is doing in terms of trying to take the border issue head on to Trump's doorstep, saying you're the one that blocked this deal I could have gotten done when I negotiated with the Senate? Any evidence that's actually working in terms of voters blaming Republicans?
In terms of evidence, the evidence is scant, right? We had a Bloomberg Morning Consult poll over the last couple of days that came out that showed that more voters blame Republicans for what's happening at the border by about a 5 percentage point increase. That's not a whole lot, again, given just where Biden is on the issue. If you look at former President Trump's recent stump speeches, you can see semblances of what some of his key aides are probably telling him, because he said something something the other day at a rally about immigration being baked for Democrats. One in our field can take that to mean that probably his analysts or his aides told him that it's so baked in that it's worth this kind of political gambit that he's pulled off to convince his party to renege on that deal that they had.
Hey, Mario, great to get your thoughts, as always, buddy. Mario Parker down in Washington, D.C. on the latest, the difference between the former President Donald Trump and the sitting President Joe Biden on the southern border. Here's a headline for you. Torsten Slock, Apollo, the Fed will not cut rates in 2024. It's quite a call. The reality is that the U.S. economy is simply not slowing down, and the Fed pivot has provided a strong tailwind to growth since December. As a result, the Fed will not cut rates this year, and rates are going to stay higher for longer. He offers 10 reasons. There's a very long list of reasons. I'll go through the 10 for you. I'll shorten them down and just go through the bits that he highlights in bold. The economy is not slowing down. It is re-accelerating. 1. 2. Underlying measures of trend inflation are moving higher. 3. Supercore inflation, a measure of inflation preferred by Chairman Powell, is trending higher. 4. The labor market remains tight. 5. Small business are planning to raise selling prices. I'll go to point 6. Manufacturing surveys show a higher trend in prices paid. 7. ISM services prices paid, also trending higher. Point 8. We're going to raise worker compensation as well across businesses. Point 9. Asking rents are rising, and more cities are seeing rising rents, and home prices are rising. And point 10, financial conditions, the obvious one here, Bramo, easing. Equity markets are rallying to all-time highs and credit spreads are very tight.
That, to me, might be the most interesting one, that essentially the indication that we got from Fed Chair Jay Powell at the end of last year has worked against their goal to try to get inflation down. And this is basically what Avery was talking about just a couple minutes ago, that it does matter. And this is really factoring into some of the strength. That said, how many people are going to come to his view? Because Torsten now joins the Jim Bianco camp. That was a very lonely camp and still is not being priced into the market.
I want to remind you how quickly things changed last year and how many times we had a different narrative in the first 3 months of 2023. We came into the year talking soft landing. February was no landing, almost exactly where we are right now. March, what happened? Banks started to fail, and then it was all of a sudden hard landing. I think, to Torsten's note, this is the way I would think about it. The probability around a range of outcomes has shifted markedly over the last 3 months. I have no idea where we're going to be at the end of this year, but the world has moved towards that perspective. The chances of that happening now are so much higher at the start of March than they were even a month ago.
There aren't the signs of the cracks that everybody was looking for. Again, that list of worries, tick by tick by tick, each one's being taken off. Unrest in the Middle East, oil prices aren't really moving. Yeah, they're ticking up just a little bit. Concerns about inflation, well, you know, that's kind of sticky around the edges, but it's coming in some places. All of these worries seem to be kept in check just enough for basically inflation to not come down as much as many people expected.
We'll turn back to that note in just a moment. Equity futures right now on the S&P 500, slightly softer. We're negative by 0.1% on the S&P. Looking at the bond market, Treasury yields lower by a basis point or two at the front end of the curve. We're down 2 basis points to, let's call it, 460. Coming up on this program, oil capping a second straight month of gains as cocoa sees its biggest rise in 22 years. We'll dig into the commodity market with Bloomberg's Javier Blas up next on the program.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Not sharing my thoughts on that. No chance. Equities on the S&P. Not a chance. Negative by 1/10% on the S&P. We're going nowhere on the NASDAQ 100. Torsten Slock of Apollo, the Fed will not cut rates in 2024. Here's the why. The reality is that the US economy is simply not slowing down. The Fed pivot has provided a strong tailwind to growth since December. What could this mean for this bond market? Switch on the board and get to the 2-year. This 2-year has been as low as 4.1% this year, as high as 4.7%. At the moment, 4.6, yields down by a basis point, helped out by PCE coming in line with expectations yesterday. You get no hikes this year, so you've got to price out another 3 cuts this year. What's the upside potential on that 2-year?
We were hearing yesterday that it could be easily 5% from Ira Jersey, and a lot of people are saying, why wouldn't it be? Over the next 2 years, if you're talking about a Fed funds rate that's going to remain, at 5% or 5.5%, I love Torsten Slock's note, the way he began it, because it basically was, you all have been so bearish and you have all been so wrong. The market came into 2023 expecting recession. The market went into 2024 expecting 6 Fed rate cuts. You look at the data, and that's the reality, at least what we're looking at right now, and it's strength.
Can we get to point 10 on that long list of reasons as to why they won't hike this year? Financial conditions continue to ease. Doesn't that become slightly more compromised as we start to come around to the world that Torsten Slock is living in, if we do indeed go in that direction?
This is the game theory of the moment that the Fed's in right now, that essentially, can they get to the inflation rate that they want if the market thinks that they're actually going to be accommodative and try to keep this party going, to use the parlance of a lot of our guests. And right now, you can see this play out in the mortgage market. When rates go down, even 0.5%, you could see people apply for mortgages. You can see that uptick in a significant way. Then rates rise back up, everybody goes away. Yeah. You can see it in real time. That is financial conditions easing and tightening, and really you can see it.
3 cuts this year is consensus. No cuts this year is certainly not consensus, and you might say yet. In the bond market at the moment, we're down 2 basis points on a 2-year, on a 10-year, down a single basis point to 4.24. If you can turn to foreign exchange to switch up the board and get to the euro, talk about a euro that's slightly positive by 0.1%. Speaking of an ECB that might not be able to cut rates anytime soon, well, they might not be able to. Upside surprise on inflation, Bramo, over in the Eurozone. Look, it's coming down, it's coming in, it's still in at around 3, which is better than 4 or 5 or 6 or 7. We're moving in the right direction, just not as quickly as some people hope for today.
And where it's coming from is important too. It's not coming from services. This is coming from other areas, the goods disinflation that continues. So at what point do you need to see services inflation come in much more aggressively for the ECB to get on board?
Governor Waller at the Fed said, what's the rush? And just listening to the Austrian Central Bank governor a little bit earlier this morning, you got the same feeling. That man is not in a rush anytime soon. Under surveillance this morning, your top stories: New York Community Bank shares plummeting, the company announcing, quote, material weaknesses in how it tracks loan risk. The bank saying the weakness results from ineffective oversight, risk assessment and monitoring activities. That's a quote no one wants to write. NYCB also announcing a change in management and warning investors it expects to miss a deadline to file an annual report as it shores up controls. That stock, Lisa, on my screen right now, it's off the lows. It's still down about 20%.
Yeah, I mean, it's trading sub $4 a share. So we're talking about a company that's been really beaten up here over the past couple of months. To me, I think the more interesting aspect of this story is how it is being treated as an isolated event. People are buying into the idiosyncratic story, hook, line, and sinker. And whether that's true or not, that shows you how much sentiment has shifted.
To be fair, for good reason. And if you are just joining us at home and you missed the numbers earlier on today, I think these numbers kind of matter, that their largest real estate exposure comes from $37 billion in apartment loans, with almost half backed by rent-regulated complexes. That issue is truly, I'm going to use that word, idiosyncratic.
And that's how it's being treated by the market. The issue that I have is, why did they not have a better handle on what risk management issues there were, say, a month ago when the kitchen sinked it the first time? Again, is this an NYCB issue? Is this a broader issue? So far, the reason why the shares are lower is because of that, but not more broadly.
Execution versus just where the market is, and clearly they had a big execution problem. Let's turn to the latest on politics. President Biden walking back his comments on a Gaza ceasefire, telling reporters he's hopeful but no longer expected to happen by Monday. The White House saying Biden spoke with the leaders of Qatar and Egypt yesterday. The two nations are helping to broker a peace deal between Israel and Hamas. Now, the cynical who are listening to all of this, AMH, they might say those comments were made just ahead of that Michigan primary to try and get some support that he otherwise didn't have.
Already, that's what people are saying. He wanted to make sure he said something about Gaza, about this potential for ceasefire, before he knew a lot of Arab and Muslim Americans were going out to vote. They were going to vote a protest vote. They don't want to see Biden as the candidate. He said hope springs eternal, so he's still hopeful. I think if a deal was to get done, it would have to be before Ramadan on Sunday. But I would note that yesterday there was a deadly confrontation in Gaza, and now you have the White House saying they want to investigate this. You have dozens of Palestinians dead, and that is going to make it much harder for this administration, because it's going to make the hostage talks much harder when you have continued flare-ups like this.
Yeah, the mood has changed pretty quickly. More on that a little bit later. Let's turn to the latest on Tesla, rolling out a number of incentives to drive sales in China. The company facing stiffer competition from local rivals like BYD. The incentives include insurance subsidies and discounts on some paint colors. Tesla's lowered the price of its Model 3 and Model Y cars in China by as much as 6% in January, triggering further cuts from local competition. I think we can call this a price war, with BYD slashing one of its models by 20%.
Can Tesla play? That's what I want to see. How much does this really cause a real issue for Tesla that already has seen its margins and its margin hopefuls come in quite a bit? Also, do they then have to cut prices in the U.S., or are these markets completely divorced from one another, as basically the U.S. says it's going to throw up the walls to any Chinese cars? That, to me, is going to be a really interesting conversation that we're going to continue to have.
Well, you're paying a little bit more than 27% tariff if you even wanted to import a Chinese car right now. So I think Tesla can remain competitive in the United States. The issue is worldwide. And Elon Musk spoke about this in the last earnings call. He said that if there aren't trade barriers, BYD would, quote, demolish the market.
Yeah, it's not about whether Tesla can compete here. It's about whether Tesla can compete there, whether they can and whether they'll be allowed to compete there. If you end up in this situation, Bramo, and we don't know what's going to happen here, but let's just go through the White House statement from the president yesterday on the national security issues around Chinese vehicles. Let's say they go as far as effectively banning these vehicles, that you can't buy them in America. Are the Chinese just going to sit there, the authorities, the CPCP, to allow foreign manufacturers to sell in their market when they can't sell abroad? What happens next?
There are a lot of people speculating there will be some sort of retaliation. I just think we can't really game this out in any kind of linear fashion.
It's hard.
And I think that the other question that I have is, what is the price at which an electric vehicle can be sold where you break even? And how does this really stymie if you have less competition? How much does this keep prices higher on electric vehicles ultimately in the United States that leads to lack of demand, which we've seen consistently?
You were brilliant at this yesterday. Yesterday, this was just slightly different. This wasn't just about unfair trade practices, their ability to produce these vehicles with cheap labor and big subsidies, state-sponsored industries. And let's be clear, we have a state-sponsored industry here right now in America as well, and over in Europe too. This was about national security. That's a very different ingredient.
Well, but how much are U.S. individuals willing to pay for national security? How much are people willing to really go with this? And this is the reason why I say, yes, it's about national security, so it's going to go through. But what does that mean for electric vehicle adoption if people are going to ultimately have to pay higher prices? And that, I think, is something that a lot of auto manufacturers are grappling with right now.
Tesla just a little bit lower in the pre-market. No drama there. No drama at all. Oil posting a second straight monthly gain, with traders expecting OPEC Plus to extend voluntary supply cuts into the second quarter. Javier Blas of Bloomberg Opinion writing, quote, the market anticipates a full rollover. Instead, I believe the cartel has a chance to add a bit of extra supply, taking some short-term pain for a long-term gain. Javier joins us now for more. Javier, can you walk us through that? What would the long-term gain be from doing that now?
Well, Brent crude is already at close to $85 a barrel, and I think that what OPEC is doing, if we continue to restrain production at the same level as it did in the first quarter into the second quarter, is going to continue adding a few more dollars per barrel to that price, and it's going to be subsidizing the U.S. shale industry. We know that each dollar matters in the Permian, that each dollar really triggers a significant increase in production. And I think that the time is for OPEC to say 80, 85, that's enough for us. We do not need to subsidize the U.S. shale industry, because if not, if OPEC continues to restrain now, what they're going to find is going to be a lot harder later on the year, because shale production is going to be higher than expected. So that is the gain.
There's a real question about where the sort of line in the sand is for OPEC Plus in terms of pricing. How low can prices go before it's unsustainable for a group of countries that have relied on crude income for almost all of their investments?
The main problem is you cannot ask that question to OPEC or to OPEC Plus. It very much depends on which country you ask. There are some smaller, richer countries in the Middle East, say Kuwait, the United Arab Emirates, which can live perfectly happy with current prices or even much lower. I think that some prices in some countries in the Middle East, $65, $70 is something that they can take. You ask the same question in Saudi Arabia. I think that the current price of $80, 80 to 85 is the bare minimum that they are prepared to accept. Very similar question in Russia. The key difference from like the OPEC that we used to know 10, 20 years ago, it is the Saudis who really want the high prices.
So what's the Saudi ceiling then, Javier?
I think that the Saudi floor for the price is somewhere around $80 a barrel. They want to guarantee 80, so probably they are aiming somewhere between 80 and 85. I think that they are very happy to keep oil prices all the way up to $100. They don't see a particular problem for the global economy at those levels that we have been before. They believe that the global economy can take it. So I think that the Saudis sit very comfortably somewhere between 80 and 100.
We're actually bearing the lead with you, Javier. You, before I'm going to reveal something, that you admitted that you are stockpiling chocolate. Why are you stockpiling chocolate? Do you really think that it's going to get that much worse out there?
I stockpiled olive oil last year. I was very happy when the price went through the roof. I'm stockpiling some chocolate because we eat quite a lot at home. Must confess that. And the price of cocoa is up 150%. You make chocolate out of cocoa, a bit of sugar, a bit of milk. Prices of chocolate on the supermarket, it's gonna go up and go up quite significantly over the next 6 months. The market for cocoa is facing a structural deficit. Supply is well behind the demand. Probably the gap between demand and production is going to be in 2024 the largest it has been at least in 65 years. So we have a problem, and the only cure for the market right now is higher prices. So we are going to see a bit of higher prices in the supermarket. So I'm just anticipating from that.
Higher prices, less chocolate. That's already what these chocolate companies are telling us, Javier. But when you look at the market in terms of cocoa, is it what's going on in West Africa in terms of bad weather and drought and disease on some of these crops? Or is it tariffs that are coming into play from Europe?
There is a mix of factors. I mean, certainly the weather has been very unfavorable. It has been dry recently. It was too wet a few months ago. We have new regulation from the European Union on deforestation, which means that beans that have been produced in new planted area cannot go into the European Union. That's not going to help. But I think that the biggest problem is that the world is relying on a group of West African countries for 60% of the cocoa. That's Ghana, Ivory Coast, Nigeria, and Cameroon. There has been very little planting in those countries for the last few years. The trees are old. They're producing less and less. And those trees are also more sensitive to bad weather and to disease, and we have had a lot of that in recent months. Diseases are really quite widespread, both in Ghana and Cote d'Ivoire, and Ghana and Ivory Coast, and that is the big problem at the moment. But it's a combination of all of the above, which is really restraining supply this year and perhaps also into next year.
Javier, would you like to explain to our American audience why they shouldn't worry, they shouldn't fear, they shouldn't stockpile, because the chocolate here isn't really chocolate?
Oh, you really want to put me in trouble. I really, as with olive oil, I try to go to the high quality chocolate here in Europe.
Well, the high quality olive oil comes from one place, Javier. You know where that is. You and I can have a battle about that later. Javier Blas there, Bloomberg Opinion.
It's not Italy. It is not Italy.
Well, sorry, you're breaking up. Javier, sorry, sir. You're breaking up. It's good to catch up.
You know, he's not wrong, because a lot of the Italian oil is actually made with Spanish and
no, that's
and,
the fake
Portuguese.
Stuff. That's not the real stuff.
Portuguese.
I've had this debate with Javier already.
That's not the real stuff.
With one and two, he has an issue.
But you've touched on a really important point. If it was Spanish, why wouldn't they label it Spanish? Why wouldn't they? Because
people think,
and because they think it is, it's worth
more.
Because
Italy.
Because Italy's better.
Well,
so we'll leave that there. Hershey's, I think the average Hershey's bar is 11% chocolate.
Okay.
I think it's 11% chocolate.
I get the dark.
So it's not
extra
really,
dark,
that's real
super
chocolate.
dark.
Yeah, you want sort of like a 70 plus.
Well, that's if you want like the health benefits.
You
and
want actual
antioxidants.
chocolate.
You want chocolate.
Yes.
But like, you know, people like different things. I don't understand white chocolate though, because is white chocolate actually chocolate?
Kinda. More sugar, apparently.
But anyway, I will just say it's really unfortunate, and I think he's onto something with stockpiling. I know that you don't.
Oh,
think
you're going to
they
stockpile
should.
too? Okay.
I think I'm going to start
Look where you
stockpiling.
started on this program.
It's on my list of worries.
I know. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. S&P President Thomas Jordan is stepping down at the end of September. Jordan has been the Swiss central bank's chief for more than a decade. He steered the economy through the euro area debt crisis, removed the cap on the franc in 2015, and adopted the world's lowest interest rate. Don't miss our interview with Thomas Jordan later today. Dell is headed for the biggest gain in 6 months, up 24% after reporting fourth quarter results that beat expectations. Analysts say demand for AI servers is driving momentum. The stock has more than doubled over the past 12 months. Meta is winding down its news feature in the U.S. and Australia. The company will withdraw support for its Facebook News tab in April. Publishers with existing agreements with the company will still be able to push content at least until their deals expire. Lawmakers around the world have been pushing for Meta to compensate publishers for their content, but Meta says demand for the service has declined. That's your Bloomberg Brief. John.
Danny, thank you. Thank you very much. Up next on this program, striking a delicate balance in corporate credit.
We feel like this start of the year is almost a repeat of last year. Some surprises to the upside in inflation, yields moving higher, credit spreads tightening on that, and then something happens.
You know what confuses me? Reese's Pieces. That's what I just don't get them.
Because it's peanut butter.
It's just like
That's what the companies are pushing out.
I just
all the gummies and
just
the
don't
peanut
get it.
I like
candies.
Reese's Pieces.
Just don't get it.
I'm not a big fan.
No, Reese's Puffs, the cereal.
You really like that, don't you?
That's my dessert.
Okay, that's odd. All right, from New York, this is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver
of our policies. Bloomberg. Context changes everything.
Equity futures on the S&P negative by 0.05%. In the bond market, yields lower by a single basis point. The 10-year 423.85. In foreign exchange, the euro positive by 0.1%. 108.18. Under surveillance this morning, striking a delicate balance in corporate credit.
We feel like this start of the year is almost a repeat of last year, right? We had a slew of kind of Goldilocks data, some surprises to the upside in inflation, yields moving higher, credit spreads tightening on that, and then something happens. There's always something that happens.
There's always something that happens. Here's the latest. Enthusiasm remains in the credit market as spreads grind down to multi-year tights in the face of a record February for corporate debt issuance. Megan Robson of BNP Paribas writing this: expectations for 2024 are high, spreads are tight, and positioning is long. But the fundamental risk profile for credit has improved, with progress on refinancings and technicals continue to support spreads at these levels. Megan is with us around the table. So Megan, talk to us why you think these themes can continue.
Well, thank you for having me, first of all. So I think what credit is really reflecting is downside risks are much lower. So if you're an investor, you're buying credit now because a lot of the risks that came into the year look better, and credit provides good carry. So for example, the maturity wall and high yield, you've chipped away 40% of the expectations that of maturities we thought would have to be refied this year, and yields are at levels relative to October where refinancings are more of a speed bump rather than a roadblock, if you will.
Can you touch on those numbers again? How much of the supply that we have seen has just been pulled forward from what we expected this year, and how much of it was catch up from last year?
It's a great question. So let's look at IG. So February, we saw 200 billion of roughly 200 billion of issuance. And the headline number has to be taken with some caveats. About 25% of that was just 4 jumbo M&A deals. So the headline number is much more in line with historical averages when you take those out. And we've also seen a lot of the issuance is refinancing. So it's not necessarily a lot of new net supply that the market has to absorb, which somewhat explains why credit spreads have been able to maintain at tight levels.
What's the bigger risk for you? The investment grade side or the high yield side? The interest rate sensitivity or the sensitivity to a turn in the credit cycle?
So I think we still have a view broadly of decompression. So I think IG will maintain a very supportive technical backdrop. We still have yield buyers coming in at these levels. If we see yields back up, there's very much a buy the dip mentality in investment grade. High yield, I think, can hold in well here, assuming that rates stay at these levels and growth holds up okay. But if we do see any risk outside of the sort of baseline scenario, I would expect high yield to be much more vulnerable.
Which is the reason why I found it really interesting. We got some of the flows data overnight from the past week. And what we could see is people are still piling into bonds, but particularly investment grade U.S. treasuries. You can see those inflows, $13 billion into global stocks. You could see, $10 billion into, or $3 billion into treasuries, and $2 billion into investment grade. It was the first outflow, though, in U.S. high yield bonds going back 8 weeks. It was not that much, $0.7 billion with outflow. Does that mean something to you about a tide shifting?
So I do think it speaks a bit to just how much we've rallied in high yield. So we're getting close to 300 basis points in spreads. That's very tight. So at these levels, it would make sense to back up a bit. Our spread target for year end is 350 basis points. So I think investors who are buying credit for the spread or the risk premium are starting to think a little bit more two-way here. They're not just piling in, but you do see more buying and selling rather than just all in adding.
We'd love your view on the Federal Reserve as well. We just had a note from Torsten Slock over at Apollo. I'm sure you heard us talking about it. The Fed will not cut rates in 2024. The quote, the reality is that the US economy is simply not slowing down, and the Fed pivot has provided a strong tailwind to growth since December. Where are you and the team on that? What do you think of that?
Yeah, so we still have an expectation of 4 rate cuts this year. We think that the Fed will start in June and continue for the rest of the year. And I think for credit, that's going to provide a relief, and a lot of our leveraged finance issuers are expecting that. In particular, floating rate loan issuers will really need to see those cuts in order to get refinancings done and see some relief to their cash flow. I think the scenario Torsten has laid out would be particularly bearish for the loan market, where you have private equity sponsors and a lot of these issuers that are thinking like, I just need to make it 6 or 12 months, and then I'll have some release on the borrowing side.
That's exactly where I was going to go. Survive until 2025. Does that become we're diving in 2025? I mean, is that sort of this idea if we don't get those rate cuts?
I think that you'll see the maturity wall and the idea of interest coverage come back into risks probably 3rd or 4th quarter if we don't see those rate cuts. So as I mentioned, maturities that have to be refied this year, we're almost halfway through those. But then looking at the end of this year, you're going to have the maturity wall step up again. If rates aren't lower, this could be coming back into the discussion.
It's a very catchy phrase. Could we just unpack it a little bit? Which companies are truly surviving until 2025? And does a 100 basis point cutting cycle of the Federal Reserve help a company that's on the precipice of failing survive?
So I think that it's not just the 100 basis points, but there's a confidence that the cutting cycle is underway. And if you're a private equity sponsor and you have cash on hand, you will have to pick and choose, and you're not going to infuse cash into every company that you own in order to help them survive. But there is this element of if the Fed cutting cycle is underway, and we could see 3 cuts this year, 4 cuts next year, then yes, I think that there is confidence that I will put this cash in the company because I can see it down the line being able to survive.
The mood has changed markedly in this market, as you know. Can you describe how the mood has changed with clients? Just what do the conversations sound like? Because in the equity market, we're trying to work out, are the pockets of exuberance? Have we taken things a little bit too far? How well received are these messages in your circles?
Clients seem very, very constructive. I think one way to see that more quantitatively is positioning. So we have a positioning indicator. It's in the 90th percentile. Positioning is very long. I think that the one place we haven't seen investors add is really the lower beta part of the market. So triple Cs, you're not seeing a wholesale buying of that, but look at single Bs in high yield credit, the second riskiest rating bucket, top performer over the last month. So I think it reflects this positive conviction for the rest of the year among investors.
It's been amazing to see this credit market over the last month, Bramo. Spreads super, super tight, tons of supply.
I'm just thinking about survive till 25. I mean, I really think that it's a good point because it really matters why the Fed is cutting rates. If the Fed is cutting rates because it's just sort of trying to keep this party going, then great, get it, yep, go. But if it's because there's real damage, that means spreads are going to widen at the same time. It's going to create a very different type of scenario that doesn't exactly look like thriving in 25, but maybe, hobbling along still.
And not all rate cuts are created equally. Megan, it's good to see you.
Thank you so much for having me.
Thank you so much. Megan Robson there, BNP Paribas. Coming up on this programme, Michael Purvis of Tallbecken, Ellen Hughes Cromwick of Third Way, Lara Rame of FS Investments, and Chuck Grum of Gordon Haskett. Live from New York City, counting you down to the opening bell about 94 minutes away. Equity futures are totally unchanged on the S&P 500. Yields are a little bit lower, down about a basis point. Crude's higher by 1.74%. WTI, 79.63.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. So this is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
Rates market moving closer to where we think things should be, which is around 3 cuts.
There is certainly a lot of risk that the Fed waits a little bit longer. They're likely to err on the side of caution.
The big disconnect at this point still is that once we start cutting, we're going to cut aggressively towards a normalized world.
The Fed is more likely to simply remain on the sidelines rather than re-engaging in further rate hikes.
I think it's becoming increasingly likely that maybe we have no rate cuts this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
And maybe we don't, and she's not alone. Live from New York City this morning. Good morning, good morning.
No.
For our audience worldwide, what's wrong with you?
I live for this. Let's get you to the weekend. Come on. Can we do that again?
What are you breaking up the show for?
Well, you did.
The camera's moved
Come
now.
on.
John, can you send the camera back? Can we do the move again?
Can we do it again?
Do you want to do it again? I can do it again.
I mean,
get the camera to go back in the room.
Yes, I think that we should.
Let's
get
John,
you.
can you send the camera back and I'll do it again?
Let's get you to the weekend. Can you say it?
I need the count in my ear.
Otherwise, you're not going to say it.
Thank you. Silence. Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide.
Thank you.
This is Bloomberg Surveillance. Maybe I would have got there, Just let me complete a thought, Bramo.
There's no way you would have gotten there.
Jeez, you're on form today, aren't you?
I can't help myself.
Maybe we won't get any cuts, all right? I'll go through the note. Lisa Abramowitz, everyone. Anne-Marie Hordern, Jonathan Ferro, Torsten Slot. The Fed will not cut rates in 2024. The reality is that the U.S. economy is simply not slowing down, and the Fed pivot has provided a strong tailwind to growth since December.
Yeah, well, this is the issue. More people are coming around to this idea, albeit on the margins, but how much does that really kind of create a reality check to a market that's hitting new highs and where everyone seems to be shrugging off all their concerns?
I've never seen you so keen for the weekend in my life.
No, I think it's been an exhausting sort of whipsaw feeling of incremental moves and people just sort of grinding higher, not feeling too enthusiastic, but, you know, kind of, there's nowhere else to go.
Let's do this. Let's go here. Let's push ahead to next week. We'll talk about next Friday. Okay, let's look ahead to next weekend. Payrolls Friday. I'll give you a sneak peek of the survey. 190K is the median estimate in our survey so far. There's some moving target. We'll put together more of these estimates for you, and that number might move. But at the moment, 190,000 is the number. That's down from the blowout jobs report we had north of 300K in the previous month. If you look at unemployment, we've had unemployment south of 4% for 2 consecutive years. It's been phenomenal. We're still looking for that, Lisa, to stick at 3.7.
Here's the thing, and I think this is a reason why Torsten Slok is coming out and saying maybe we're going to get no rate cuts this year. If you come up with a theory, it might call for weakness. If you look at the reality, it ain't showing that. So then when do you start to say the reality is portraying a strength that we have to reflect in some of our forecasts?
That's the reality in the economy for the forecast around the labour market. Let's talk about the politics as well. So we're avoiding a near-term government shutdown. I'm not sure if we can avoid one entirely this year, but for now we can. Then we got Super Tuesday with Nikki Haley's campaign just about holding on. And then AMH, the president, delivering the State of the Union about a week away.
Yep, delivering the State of the Union. It's a huge week for politics next week. What is he going to say in the State of the Union that pushes his campaign forward? We have reporting this morning that he's going to talk about tax cuts. My issue when the Democrats are talking about tax cuts is that they had a chance to roll back a lot of the Trump-era tax cuts early on of his administration, and they didn't do it. They weren't even able to close carried interest loophole. So what is he going to talk about? On the campaign trail, we have seen him, maybe he won't address in the State of the Union, we have seen him talk about raising the corporate tax rate, getting closer to the 28%. Also then, Political's reporting that, one of your favorites, Jonathan, he might address shrinkflation. So we're talking about the economy. The job market is doing well. This is something the president is going to tout, under 4% for 2 years. But inflation is still hurting them when it comes to consumers. And they're going to bring it up by saying, actually, it's the company's fault.
I can't wait for the Friday morning coverage of that speech on that very issue. Need to turn to the price action. Bit of a delayed start to this hour. I think we can cut out the beginning of it, can we, for the online version?
Well, you
want to
could
keep
have
that
said,
in?
you could have started the right way.
Keep it. I did in the first hour. I said, let's get you to the weekend.
But you could say, heading into the 8 o'clock, it felt like, you know,
you want me
how
to
do
do
we
it
get
again
there?
twice?
No, it's okay. All right, you're okay, Carrie.
Can I proceed? Equities unchanged on the S&P 500. Are you turning into Tom? Is that what's happening here? That is so needy. In the bond market, 425 on a 10-year at the moment. Coming up this hour, Tal Becken's Michael Purvis on why markets still have room to run. Ellen Hughes-Cronwick of Third Way on why EVs will be central to US economic leadership. And Laura Rame of FS Investments on why she sees interest rates normalizing at higher levels. We begin with our top story this hour, kicking off March with stocks at all-time highs and strategists on Wall Street racing to upgrade targets. Tal Becken's Michael Purvis saying this: I'm quite constructive on both the economy and markets. I think seeing 5,500 on the S&P or even higher is a distinct possibility. Michael Purvis is with us around the table. Michael, good morning to you.
Good morning.
Goldman Sachs, 5,200. That's an upgrade. Piper Sandler, 5,250. That's also an upgrade. Barclays, 5,300, an upgrade. UBS in the last week, 5,400. You're saying 5,500 and beyond. What gets us there?
Well, you know, we had this condition, I think, really after the December FOMC, which I call sort of dual Goldilocks, which is that you've got the Fed stop talking about hikes. Now, I'm actually on Torsten Slok's page about very few cuts, maybe zero this year. But I would also argue that the Fed, the lack of hiking is really what's key here. He has announced, sort of that big message of pivoting away from hiking to, if anything, the action is on the cutting side, right? So that's a very important thing from sort of the Wall Street side. Now, the dual Goldilocks condition means that concurrently, and this is really unusual by the standards of the last 12, 14 years, is that you have a worker consumer that's kind of in a Goldilocks condition as well. Not perfect, of course, it never is, but you have the worker consumer where real wages are climbing, where inflation broadly is falling, and you're starting to see nominal wage gains really come higher and higher and higher. So the concurrence of that, where you have a Fed pivoting, doing a dovish pivot into 3.7% unemployment with GDP continuing to be strong, is really pretty remarkable.
Pause, Michael. You can imagine a world where we get to 5,500 beyond this year with no rate cuts in 2024?
I think that's I can, actually, right? I mean, I think what's really underscoring a lot of this is a shift, a very slow, subtle, but increasingly probable shift of going from what we knew before COVID of sort of very low, sort of the low inflation, low nominal world into something with a higher inflation floor, but also growth, right, and a higher nominal GDP outcome there, where interest rates are going to adjust towards that, right? And so I think, look, I'm at 1 to 2 cuts this year. I'm not at Torsten Slag's 0 cuts there. I think there's a very reasonable case for 0 cuts. But if the earnings are there, and let's not forget that you put up my quote about the Mag 7 will drive the rally here. Let's not forget that you're looking at 20% earnings growth year over year for the Mag 7 here, right? And even as inflated as those multiples are, if you look at the price earnings to growth ratio right now, it's around 1.1 for the Mag 7 there. That's a very attractive.
You keep saying 7, but you actually said 6.
Yeah, no, I know.
So who's dropped off this list?
Well, that would be, of course, be Tesla, but it's also dropping them out is less consequential. But no, like of all those stocks to report, they had the one thing that was the sort of most problematic on earnings. They're also the smallest, and then they have a whole bunch of secular headwinds to face with the whole EV narrative sort of evolving as well. But those core 6 are the big ones, right? And those are the ones that are really driving the big tech story, but they're also really driving, underscoring the broader S&P rally.
Which raises this question, do you need different leadership, or is it just going to be the same thing, which is Magnificent Six, I guess, basically driving this, even if rates go higher, and continued underperformance from the Russell 2000, from consumer cyclicals and other kinds of issues?
I think that the textbook tells you that, oh my God, the lack of breadth is a real vulnerability. I don't know if that really has to be the case, right? I mean, if these companies are able to generate the earnings that the street expects them to do, right? And they end up lifting up the other ones, as long as the other 490 odd stocks don't fall apart, right, on an earnings or fundamental basis there, and they basically hold together, right? I don't see why that really has to be problematic. It's weird, but I don't think it's necessarily problematic.
So what's the hedge? I mean, this is really the key question, because basically you're talking about the potential for no rate cuts and basically a sell-off in bonds potentially at a time where that used to be the haven. Where do you go now?
Well, if you want a market hedge, I would certainly advocate looking at VIX calls over S&P puts. I've been continue to be on that page for a whole host of reasons. If you're asking me about, like, okay, well, duration is not as safe as because of the sort of, what I look at as sort of a slower motion version of late last summer's backup in yields there. I think look, I mean, I think I don't want to say big tech is a safe haven there, but their business models are pretty strong and so forth. I think if you're a long-only manager, you have to think about that those earnings, even as inflated as the valuations are, look, you look at things like gold and so forth.
Bitcoin?
No, well, I won't, but you can.
But I'm just thinking, I'm listening to you talk, and I'm thinking, if you see big tech as the growth driver, you see big tech as the potential safe haven, why not just lever up, go all in, bet on them completely?
Well, I think I would probably refrain from doing that, right? I mean, I think the market is capable of just pushing these. It's been pushing these stocks for a while. What I'm saying, Lisa, effectively is that the valuations for the markets have gone through massive contortions over the last 4 years, right? With all the increase in rates and all that. I think the PE expansion or contraction story is kind of behind us. And right now, if there is earnings growth, those equities will go higher. And I do think you can expect earnings growth from the Magnificent Six to be reasonably strong this year. I have bigger questions about, say, the S&P equal weight.
Can I just finish on the auto sector? You dropped Tesla out of the Mag 7. Sure. How investable is the auto sector in America right now?
Well, look, I'm not an expert on the auto sector, John, but I would certainly say this, that I think there are massive questions about whether EV is going to stick, and I'd say it's whether the price, whether the pricing can adjust and the business models can adjust to that. I think it's definitely a brainer. I think it's pretty tricky.
Yeah, big time. Michael, thank you. Michael Purvis of Tallback and Capital Advisors. We'll be talking with an expert in just a moment. I do love Wall Street. I'm not an expert, but you've always got an opinion, Michael. Come on. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. S&B President Thomas Jordan is stepping down at the end of September. Jordan has been the Swiss central bank's chief for more than a decade. He steered the economy through the euro area debt crisis, removed the cap on the franc in 2015, and adopted the world's lowest interest rate. Oh, and also handled the collapse of Credit Suisse. Don't miss Bloomberg's interview with Thomas Jordan. That will be later today. President Biden plans to increase taxes on corporations and the wealthy and lower prescription drugs, and he'll address all of that in the State of the Union next week. Biden plans to lay out his economic agenda for a potential second term in office, trying to convince voters that his administration's efforts warrant another term. The State of the Union address takes place on Thursday evening. Treasury Secretary Janet Yellen says any plans to seize Russian assets cannot be seen as a replacement for aid to Ukraine. Ukrainian aid has been a key issue that's been held up in Congress, now in the third year of a war with Russia. In an interview with Bloomberg, Yellen said that the EU has offered Ukraine, quote, very meaningful finance, but the total just doesn't seem like enough. That's your Bloomberg Brief, John.
Danny, thank you. Bramo, we're going to take a break now, all right? Just going to go to the commercial break, take 3 minutes out. You know how this works. Up next, you ready?
Go for it.
The US cracking down on Chinese EVs.
You'll have Tesla competing with like the best Chinese players, BYD, and it's going to be very hard to make a living outside of these two poles in the industry.
Let's get you to the weekend.
Yes.
There you go. I'll just repeat it for the rest of this hour. I've never seen you like this. From New York, this is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kayleigh Lines, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg. Context changes everything.
It's a quiet start to Friday morning, going into the weekend totally unchanged on equity futures on the S&P 500, going almost absolutely nowhere. Yield to higher by a single basis point on the 10-year, 426.60. Under surveillance this morning, the US cracking down on Chinese EVs.
Tesla has been doing an extremely good job, has pushed like the bar very high, and now the Chinese are coming in. filling the void around Tesla, and the competitive gain between Tesla and the Chinese is not going to leave much room for others to be successful. You'll have Tesla competing with like the best Chinese players, BYD, and it's going to be very hard to make a living outside of these two poles in the industry.
Here's the latest this morning. The White House ordering a probe into potential data and cybersecurity risks posed by Chinese EVs. President Biden issuing a statement saying this: China's policies could flood our market with its vehicles, posing risks. I'm announcing unprecedented actions to ensure that cars on US roads from countries of concern like China do not undermine our national security. Joining us to discuss is Ellen Cromwick-Hughes of Third Way. She's also the former chief economist for Ford and the US Department of Commerce. Ellen, it's wonderful to catch up with you. I have a first question, an obvious one. If Chinese vehicles are going to pose a national security risk, what are the chances that maybe they're just banned?
Well, we did hear from Secretary Raimondo this week following the statement from President Biden. And basically she said, look, we're going to look at everything. We have to study this. We have to make sure that we protect and our national security is not at risk. So they're looking at everything. I think she said all the way from banning to ensuring that the tech in the EV is American made or made by one of our trading partners. So they're going to look at everything. They do great studies at the Department of Commerce, as you know, and I think it's worthwhile. I mean, we have to make sure that we protect and we have national security, freedom, and capitalism at the top of our list.
Ellen, do you think this is more a matter of national security or preserving jobs in Detroit?
I think it is first and foremost national security. As you know, we've seen over the last couple of years instances where our national security has been compromised. And we know that we have to make sure in the future that we protect and defend. And that's absolutely critical. Now, the U.S. manufacturers, Ford, GM, Stellantis, a lot of our other manufacturers, they're not shying away from competitiveness. Nobody wants to have a protected market that means that basically we end up weakening our product creation over time. We need competition to make sure that we have ongoing innovation. And innovation, as you know, is key in the electric vehicle market. There's been a lot of it, but there's more coming.
Well, Ellen, and the source of that innovation has been in China. The source of that innovation and bringing down the costs are really in BYD and the likes that we've seen coming out of the world's second biggest economy. Don't you think that it would essentially hamper the trajectory to a more electric vehicle-friendly future to ban Chinese vehicles from being sold to the U.S. and bringing down that price point aggressively?
Well, Lisa, let's step back for a minute. Look at VW. Look at Ford, their initial first-generation electric vehicles. GM, they're making progress. They've made commitments. Tesla, we've also seen incredible product now coming out of Hyundai Kia. So let's stand back and say it's not just China. Now, let's look at China. They have been subsidizing their electric vehicle industry for 2 decades now. I mean, I remember at Ford when they started the subsidy programs, and they invited U.S. leaders, manufacturers like Ford and GM to China to help them with product development, modeling, forecasting, innovative product creation. So it's not like it happened in China without a lot of support. So now what do? We have to get competitive. Look, this industry is going to electric vehicles. I know you've heard from guests that are wobbling on this, but we did a study on competitiveness. If you go to Third Way, When America Leads, basically you've got $27 trillion of addressable market between now and 2050 as we transition to EVs. So it's not a question of if, it's just when. Infrastructure and product development and rolling out an emerging technology, all of that takes some time. It's not like it's going to happen in a quarterly earnings report.
Ellen, we have Giorgia Meloni, the Italian leader, visiting the White House today, and Italy is said to be asking BYD to potentially come set up shop and be another manufacturer in Italy, while at the same time the U.S. is thinking of completely banning potentially EVs. I thought this administration always wanted to take a multilateral approach when it comes to China. Doesn't this administration potentially need to shore up where the Europeans are as well when it comes to Chinese EVs?
Super good question. And, you know, Italy used to have an automotive industry. And, you know, so I can understand why they want cheap vehicles coming into their market to satisfy where they are in terms of their economic growth and prospects. But here in the U.S., we have already developed the beginnings of an electric vehicle market. And listen, have at it. You know, if we find that BYD, you know, ends up with no national security risks, come into the market. I don't think anybody is shying away from competing, but we need to make sure we understand that that market in China has been subsidized for many years. But we're not going to lose in terms of our automotive market. Look, we've got 4 million jobs in the automotive industry, and then a job multiplier of about 10, where those paychecks of workers are being spent in local communities on businesses, retail businesses, and all different types of, consumption. So, you know, it's not like our auto industry is going to go away. It's absolutely core to our U.S. economy. And that's why EV policy is really working. In fact, there's a study that was done on clean energy investment, cleaninvestmentmonitor.org, if anybody's interested. In the fourth quarter of this year, there was $12 billion. That's inflation adjusted at a quarterly rate in terms of investment in the EV supply chain, critical minerals, batteries, vehicle assembly, and charging equipment. So there's been a lot of investment growth in the EV supply chain just in the last year. And we're only starting because a lot of these programs last for about 10 years.
And I just have to say only one piece of pushback. You can't say Italy used to have an auto manufacturing industry. There are 5,000 employees in Maranello who will be deeply unhappy. Ferrari, Ellen Ferrari, come on. Ellen, thank you. It's good to see you. Ellen Hughes-Conwick there.
Good catch.
At Third Way. Ellen, thank you. Going to offend half of Italy here.
You're like an Italian.
A whole region.
You know, you're the ambassador.
You've got to police the conversation a little bit. You know, like I could carry on listing it anyway. All right. Coming up very shortly, Laura Rame of FS Investments on why investors should reframe their interest rate outlook. We'll be talking about that, particularly after Torsten Slok of Apollo came out with that big note a little bit earlier this morning, basically making the point that he does not think this Federal Reserve will cut at all this year. We're going to catch up with him on Monday at 7:30 Eastern Time. So get that one on the calendar.
Basically, good news is good news. Treat it on its face, but it's going to be bad news for the Fed rate cuts. And that's seriously what a lot of people are thinking about. But we just heard from Michael Purvis, it doesn't matter. We can still get to 55.
And Jerome Powell is on the Hill next week. So this is going to be the first question. What is the timeline for these rate cuts? Because remember, he went out and talked to 60 Minutes, basically saying, I think shoring up the American public in a political election year, why he had to go down this path.
You know how this works, though, down in Washington, D.C. You turn up, and ultimately you say the same thing you said in the last news conference. Maybe you inject something new, something fresh if you want to, and he can. He has the opportunity to do that. But it's always the lawmaker making a clip to make a commercial to speak to his constituents or her constituents.
You're just as exasperated as I am.
I hate it. It drives me nuts.
The rooms are empty.
They practiced in the mirror.
Of course. It's all a shtick.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
The Italians are writing in. People at Ferrari would also be insulted if you referred to their product as merely autos. Well said. Art. Art. Equity futures on the S&P 500, unchanged on the S&P. On the Nasdaq, positive by 0.1% on the Nasdaq 100. A little bit of a lift here as we close out the trading week. In the bond market, yields look like this: 2-year, 10-year, 30-year, 2-year higher by around about a basis point. On a 10-year, up by 2 basis points to 4.27. Lisa, a little bit of a lift today, but yesterday clearly moving in one direction off the back of an inline PCE report.
And I think you made a great point. Is inline the new beat? That we're now just looking for boogeymans under the covers, and if we don't get them, well, then all systems go rally. But here's the question: how many people are going to come around to Torsten Slok's view of the world? No rate cuts this year if the economic data keeps being this strong.
Stay tuned for Laura Rain of FS Investments, who believes maybe we are normalizing to a much higher rate profile in this market. That's worthy of conversation. Let's finish on the euro. The euro against the dollar at the moment, positive by 0.06%, 108.11 on that currency pair. A little bit earlier on this morning, we had some Eurozone inflation data. Wrong kind of upside surprise on CPI. Bramo, just pushing back the timeline again of that conversation. The need for urgent rate cuts in Europe with a growth profile that probably needs it. If they didn't have this inflation story, rates wouldn't be here. Let's put it that way.
So consumer prices rose 2.6% from a year ago in February in Europe. That compares to a 2.5% median estimate. It's where the price pressure came from, in my view. It comes from the services side. Again, this isn't coming from sort of the more fluctuating kinds of commodities and goods. This is really sticky services.
If you're getting excited for action, there was all this talk about a March rate cut from maybe the ECB, maybe from the Federal Reserve. This was a conversation that's only about 2 months old, and maybe a BOJ rate hike. And based on what we heard from Governor Ueda, doesn't sound like that's a man who's going to hike anytime soon. I will caveat that with this. It wouldn't be the first time the BOJ has just come out and changed its mind at the meeting, or at least just done whatever it wants without feeling the need to communicate it in quite the same way as, say, Chairman Powell or President Lagarde.
Is it on your list of potential
worries?
surprises? Yeah.
I don't have a list, which is maybe the difference between you and I.
Maybe that's exactly
you have a list
problem.
and I just don't have one.
Well, this is the reason why you haven't seen much action in that currency pair, because nobody's willing to really get on that list and really say that's the big one.
True. 108 on the euro, about 150 on dollar yen. You're on form today. Under surveillance this morning, President Biden and Donald Trump clashing in dueling visits to the US-Mexico border.
This is a Joe Biden invasion. This is a Biden invasion. It's a military operation. I mean, we have this is like a war.
So here's what I would say to Mr. Trump. Join me, or I'll join you, in telling the Congress to pass this bipartisan border security bill.
Biden and Trump 300 miles apart, each seeking to highlight their ability to respond to a migrant surge that's become a hot-button issue ahead of November's election. AMH 300 miles apart physically, just in terms of the rhetoric, how many miles apart were we?
Rhetoric, miles apart, but if Biden does take that move and does an executive order, he'd be using the same law that Trump relied on. So when it comes to the policy, Biden is now coming out and also saying we need to do more on the border. The Republicans have pushed him there. It's a very different Joe Biden than we saw leading up to the 2020 election. Jill Biden was writing in opinion pieces about how they wanted to make sure they restored the asylum protections. They talked about bringing more humanity to the border. This is a huge problem, though, for Democrats, because polls show, Gallup this week, it's the #1 concern.
What did Obama do differently? A lot of people are talking about this as Obama as deporter-in-chief. What did he do differently that Biden isn't doing?
Part of the criticism Biden is getting is that when he came into office, he basically said, we are not going to take the same approach that Trump did. There's not going to be a Remain in Mexico. We are going to bring more humanity to this. And what people say is that was just this shot heard around the world, basically, for individuals to say it is easier now to get into the United States, and that's what we're going to do.
Okay, I just have to say, though, if you take a look at the new Trump 2.0, what he's proposing camps to basically arrest all of the immigrants, the illegal immigrants here, and then have active deportation. So it's a slightly different Trump also than the previous Trump presidency. So there is some daylight in terms of just what those measures would look like.
Waiting to see what the actual policy will be from the current administration. This president. I want to turn to a single name. Big move earlier on today. We had a move of about 30% on NYCB. Since trimmed those losses, the stock is down by a little more than 22%. The bank and the shares absolutely plunging after the commercial real estate lender said it found, quote, material weakness in how it tracks loan risks. The bank saying in a regulatory filing that the issues stem from ineffective oversight, risk assessment, and monitoring activities. None of that, Bramo, sounds good.
No, and that's the reason why you're seeing the shares fall further after already falling completely out of bed. We've been talking about the idiosyncrasy of this particular name tied to rent control issues in New York and just very specific real estate. That said, if we take the Torsten Slok view of the world, how does that reprice real estate in a more material way that hasn't been fully appreciated in some of the risk models, particularly at regional banks?
In the last 24 hours, twice, we have heard 2 credit guests say survive until 2025. What if you get no rate cuts in 2024? Why does it leave that cohort of very leveraged borrowers that are looking to finance and maybe can't get it?
Especially if you're talking about higher rates because of the strength of the Magnificent Six or Five or whatever you want to call it, not necessarily because of overall economic strength. In other words, there are still companies that are going to fall out of bed with higher credit risk, even with the overall general rosy glasses.
Let's talk about interest rates and central bank policy. New York Fed President John Williams reiterating he doesn't see rate cuts coming anytime soon.
Eventually, I do expect us to cut interest rates later this year. I think that makes sense with inflation coming down and the economy being in better balance. We're going to move interest rates back to more normal levels. But really, right now, there's not a sense of urgency to do that.
Bostic, Waller, Logan, Daly, Kugler. To sort of round out the week here, we've had so much Fed speak this week, Bramo. No big changes, I have to say. No big changes at all.
I want to make a placemat. I think that would be really fun with all
for the
of the
kids?
Fed. Yeah, and make all of the Fed heads from a particular week of speakers, and then make them run it out.
Not much has changed, and I think that's what's interesting here. Not much has changed for them. They haven't had to change their views in quite the same way this market has had to over the last 2 months.
They had 3 rate cuts this year. They've watched the market roller coaster and then come back to them. Is the balance of risks so shifting in a different way? And we talk about the potential for more rate hikes. I don't think that people are really giving that real thought. The idea of no rate cuts, though, that's what I want to hear them play with around the edges.
I've been looking forward to this conversation so we can play with that story right now around the edges. Laura Rain, Chief Economist at FS Investments, weighing in on the rate cut debate, saying this: I want to convince investors to rethink what higher interest rates can mean for investment returns. Core to my outlook is the expectation that interest rates are renormalizing at a higher level, an outlook that investors often interpret as a challenge, but I argue it should be reframed as positive. Laura, I'm pleased to say, joins us now for more. Laura, let's go straight to Apollo, to Torsten Slok, just around the corner from here. They're saying no cuts for 2024. I know you're not there in quite the same way, but the forces that lead you to believe that maybe we are renormalizing at a higher level, Laura, what are they? And do you share some of those views that Torsten has?
I do. And I think we need to always be mindful of the fact that while the Fed may signal they want to change policy, markets, the economy, inflation, it may not clear the path to the rate cuts that they are hoping for. At the end of the day, we are seeing no urgency on the economic side to cut rates. And I think we need to start to get a little more nuanced with the real rate story, because I think the Fed could surgically cut once or twice to just keep policy at the stance that it is. Markets may interpret that as accommodative, but we need to be really careful to push back against this idea that we somehow need rate cuts. I think we're doing just fine without them.
Laura, what's changed in the economy to support your thesis? What has changed over the last 4 or 5 years? It's a conversation we had with Callum Pickering of Berenberg earlier on this morning. He described maybe the last 5 years. He said if you take out the two big supply shocks, the war, the pandemic, he said we were already on a trend of higher neutral rates over the next 5 years anyway. Laura, do you share that view as well? What is leading to that? What's underpinning that?
I do, and I'm a big believer in the long run, great moderation that we experienced since the financial crisis. This business cycle being blunted by massive amounts of Fed intervention in interest rates. I think that period ended. We saw the beginning of that with the early trade wars under the first Trump administration. And I think it really catalyzed a more volatile cycle of investment. Remember, the Fed finally was able to raise rates before the pandemic. And I think this has all been sort of an unwinding of that really artificial volatility suppression that we saw with massive amounts of quantitative easing. Now, the process has sped up. And I think from here, we're out of the world where inflation stays in that 2% lane. I think, a lot of people would argue that the difference between 2% and 2.5% and 3%, it's sort of quibbling with a smaller difference. But the reality is, from a policy perspective, if you can't rely on inflation being low, you really need to be much more proactive. And that's a very different world than we've had. And let's face it, the momentum, the growth momentum, the investment that we're seeing, these are really positive, innovations. I think that's what I want to leave everyone with. When I say that interest rates are normalizing at a higher rate, I get a lot of pushback that I'm being very pessimistic. This is a great opportunity for investors that we haven't seen in decades.
Yeah, you talk about where exactly you see that opportunity, particularly in credit, high yield, leveraged loans, and private credit. I want to just sit on why we're seeing people suddenly rethink this idea of rate cuts this year in scope and size. Do you think that the fact that we did see greater accommodation in markets, there was an easing in financial conditions on the heels of Jay Powell's discussion at the end of last year, that has helped inflation stay hotter for longer, that has actually made it difficult for the Federal Reserve to cut rates this year?
I do think so. And I think, listen, there's a behavioral component to this too. Markets for 15 years have been used to rates being so low. They've gotten used to that sort of idea that that's normal. And when we look ahead, we're in a world now where if higher, the yield curve is still inverted, we need that to normalize, especially in a backdrop where we're not going to get, some sort of severe recession. So I think markets really were relying on recent memory. If the slightest opportunity, the Fed slams rates back down. We're just not in that world anymore. You go back to the 90s, even the early 2000s, we had a lot of episodes where rates were sort of in a more normally sloped way. I think that the banking system would be thrilled to have a normally sloping yield curve again, which would happen with a combination of some rate cuts, but also higher, longer term interest rates drifting higher.
That's where I was going to go. This idea that maybe the most expensive area, or perhaps overpriced area right now in the market, that some have suggested, Katie Kaminsky among them, is, say, 10-year treasuries, where you aren't pricing in this higher for longer type of scenario. How high do you think rates could go on the long end, could 10-year yields go, before it does become punitive and restrictive in a way that becomes self-correcting?
I think we're going to visit 5% again this year. And I think we need to think about the fact that, to me, it was really the speed at which rates moved that made 5% feel so punitive. Liz, without zero interest rates, you're going to see some companies that were artificially held afloat by this suppressed interest rate environment really, I think, come under distress. But I think there's a rich investment environment. There's a ton of private credit out there. These refinancings will get done. There's going to be a price adjustment, but I really think this opens up a ton of opportunity for investors. We're out of that, Tina world where there's no alternative. We're really now in a place where there is a lot of options for investors and alternatives that give you double-digit returns outside of equities.
Yeah, only a few years ago, this yield was unthinkable on a 10-year, but here we are, back to where we used to be in the good old days. Lara, thank you. Lara Rame of FS Investments. That 10-year at the moment, by the way, 427. Lara and the team think maybe we can retest 5%, Bramo, all over again. Not at the front end. We're talking about the longer end as well.
That's a theme this week. We've heard more and more guests say that the biggest mispricing right now is at the long end, not the short end, because that's been fluctuating in response to these surgical cuts. But the idea that this is an economy that's a lot hotter than what people previously thought, and that rates can afford to be a lot higher for a lot longer, I don't think we've really grappled with that.
A week today, we'll have a new payrolls report in hand. It'll be about 13 minutes old. Let's talk about it then. If that data doubles down on what we heard at the start of the year, then you've got to move. Because then it's difficult to dismiss it just as 1 month data, let's move on. You double up on that in February, then we've got a bit of a trend, haven't we?
And then all of a sudden you start to get questions about the fiscal spending and deficit, and all of a sudden you get one bad auction, and all of a sudden, yes, shoot up to 5%.
Run. Don't buy. I love how markets work, isn't it great?
It's true.
Equities right now unchanged on the S&P 500. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares of B. Riley are down in the pre-market about 11.5%. The boutique investment bank is delaying its annual report. B. Riley says its board and outside counsel are reviewing its dealings with Brian Kahn, the former head of Franchise Group. Now, it didn't give a firm estimate of when it will file the report, but in it doesn't expect any significant changes to financial results. Meta is winding down its news feature in the U.S. and Australia. The company will withdraw its support for Facebook News tabs in countries from April. Publishers with existing agreements with the company will still be able to post content at least until their deals expire. Lawmakers around the world have been pushing for Meta to compensate publishers for their content, but Meta says demand for the service has declined. Elon Musk is suing OpenAI and its CEO, Sam Altman, alleging that they have breached the AI startup's founding agreement by putting profit ahead of benefiting humanity. The 52-year-old billionaire says the company's close relationship with Microsoft and the makeup of its new board undermines its original mission of creating open source technology that wouldn't be subject to corporate priorities. Musk was one of the early funders of OpenAI. And that's your Bloomberg Brief. John.
Danny, thank you. I mean, he's kind of got a point with the Microsoft thing, right? I mean, it's like, not legally, just saying, sort of conceptually, once Microsoft makes an investment, it's not a charity donation, is it?
Well, okay, but how much of this is him just saying, you've gone on the wrong bandwagon, and it's not fair for us, versus intellectual freedom, and
sure,
let's all get everyone together and kumbaya with coding, and this is just why they get to.
Gets the conversation going. Up next on this program, the U.S. consumer continues to surprise.
Throughout 2023 and into 2024, our guest at all three of our brands has been remarkably resilient to the extent that it really surprised us a bit.
That's coming up next on the program, live from New York City. This is Bloomberg Surveillance.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
What happened was you were offered a money-losing
women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Let's check out Apple in the pre-market going into the opening bell. A bit softer through much of this morning. At the moment, negative by 0.6%. Not a major move. So Apple removed from the conviction buy list over at Goldman. Do want to point out, though, still reiterating their buy. The analyst pointing out it's still a buy. The price target's 232. It was 223. They say this, Bramo, Apple's installed base growth, secular growth in services and new product innovation more than offsets cyclical headwinds to product revenue. So still constructive overall.
Basically, we've seen that smartphone recession, and it's sort of coming back, but we heard that even from Cristiano Amon, that, you know, they're sort of in a stability point, not necessarily the growth point yet. How do you then grow profit?
The stock just a little bit lower. We're down by 0.6%. Under surveillance this morning, the U.S. consumer continues to surprise.
Throughout 2023 and into 2024, you know, our guest at all three of our brands has been remarkably resilient to the extent that it really surprised us a bit. Once they find us, they're very value focused. And so, you know, the percentage of our tickets that are taking advantage of our LTOs, our limited time offers, and our value portion of our menus are up a few ticks from where it was before.
Here's the latest today. Target, Kroger, Gap, among many retailers set to report earnings next week. Chuck Crum of Gordon Haskett expecting shopping to pick up, saying this: the combination of positive real wage growth and improving inflation should become a source for consumers to shift back to goods as services plateau. Chuck joins us now for more. Chuck, can you identify the kind of companies then, based on that theme, that you like and think maybe are underappreciated? No audio. He's on mute. We'll sort that out, Chuck, if you can sort that out, if you can hear me. You're back, you're with us, good. Chuck, you heard the question. You can carry on answering it.
Yeah, sorry about that. So I think it's important to look back, right? If you look back in the holiday period, what we've heard from a couple of retailers, Walmart and Costco, is that we're beginning to see signs of some units starting to pick up in some of those discretionary categories. So when we look forward over the next several quarters, we think that we're going to continue to see that across retail. And I think companies that we think are poised to benefit would be Target in particular. We think Target's mix of general merchandise is much higher than most of their peers. Their general merchandise business been under a lot of stress over the past few quarters, or really over the past year and a half. So it's really Target's the one we think could benefit from that trend, and we upgraded the stock about a month ago.
Chuck, going to goods, away from services, why are services plateauing? What's happening there?
Well, I think we're starting to see signs. If you look at PCE data yesterday, you're starting to see services as a percentage of total PCE start to balance out, and we think goods could start to recover, and it's really predicated on inflation. What we're seeing in food prices start to compress. We think real wage growth is accelerating, so it's a little bit of a bet, but we think it could happen.
One thing I've noticed, Chuck, is that there's been sort of a shift, just subtly under the hood in the narrative with respect to this divide between higher income and lower income families and their spending. And we've heard from several guests this week that actually there isn't that much of a divide, and that there seems to be renewed appetite among lower and middle income houses to spend as well. Do you see that same trend? Do you expect that to come through in some of these earnings?
Yeah, that's a great point. I think if you look at the pressure that the low end sees over the past couple of years because of higher energy prices, because of higher gas prices, higher food, it's really condensed to that low income customer. And as we look forward, that lower income customer is going to start to get a benefit, and we think we actually could start to see it in the month of March. You know, if you recall, a year ago, tax refunds were really low. That really hurt the low end customer. When food prices skyrocket, that hurts the low end customer. So we think the low end companies like Dollar General, Dollar Tree, we think Walmart could benefit too. You see the off price guys. You know, TJX had great results a couple of days ago. So yeah, we do believe in that trend.
There's also a question of how much this is being fueled on leverage in terms terms of credit card receivables continuing to climb. We are seeing more defaults and delinquencies. Do you think that that's a head fake because ultimately it's coming off the lowest levels in 30 years and people have actually deleveraged? Or do you think this is something that really is a warning sign?
No, I don't. I mean, it's a yellow flag. I would deem not a red flag. If you look at household debt as a percentage of disposable income, it's still really low relative to historical levels. So this isn't 2008. I do think credit is increasing to a degree, but this isn't a terrible situation. I don't think at this point in time.
Bloomberg Intelligence, though, says the amount of retail bonds facing negative rating action surged to $69 billion in February, well above the $46 billion in February a year ago. At what point do you start to get concerned then?
We'll continue to monitor, the credit data that we see, and we'll also look at the delinquencies for the retailers that we cover that actually have credit card businesses, Macy's, Kohl's, Target, Lowe's to a degree. And right now, their credit trends are deteriorating. But again, it's not a red flag in our opinion at this point in time.
Chuck, can we talk about those consumer delinquencies that have picked up more recently? We hear so many competing theories on this. Some people have pointed out that, like you have, that real incomes are increasing, so the consumer's looking pretty decent. They have space to lever up here. Other people pointing out there's clear deterioration. Which one is it?
I think we'll continue to study the data over the next several quarters and see how the consumer will begin to accelerate. And we think that's a trend that, again, going back to the holiday period and what we heard from Walmart and Costco, we could start to see. But like everything, we're going to continue to study the data. And I think it's important to keep in mind, when unemployment is at the lowest levels since the 1950s, the consumer can spend, but they're also being very discerning where they're spending. You talked earlier on your guest on value, and value is in vogue. You'll see consumers spend spend at Costco a private branded product, but they'll also spend a big ticket item. So they're just being very discerning right now.
Dime Brand's CEO saying exactly the same thing. Chuck, good to hear from you. Yep. Chuck Grom there of Gordon Haskett. Looking forward to the numbers coming next week. Speaking of next week, on Monday, here's the lineup for you. Laurie Cavacina of RBC Capital Markets, Jane Foley of Rabobank, Nuria Rabini of Macro Associates, and Torsten Slok of Apollo. Torsten Slok got a lot to answer for with that call. No rate cuts in 2024. We'll see where we are, Bramo, a week today.
I cannot wait to talk to him. I also can't wait to talk to Nero Rubini because I want to see his lists of worries.
Oh, I bet you can't.
And basically,
he's got
how
a book
much
of them, Bramo.
He's got so many events.
And how many do you two line up on?
We line up on a lot of them, but both of us sort of tend toward the catastrophic. But I am curious about how much that list has really gotten shrunk, given some of the positivity.
In the very back of that book, if you look, it says a thanks to me and TK. So I don't know how much we influenced that thinking over the years.
It's a natural sort of, safe kind of default to just kind of have catastrophic thinking.
Yeah, I mean, for me, next week, it's less on the catastrophic thinking of Lisa, but more of the information we're going to find out of Washington. Jay Powell, President Biden, and more than a dozen states go to the polls for Super Tuesday.
There's a lot on deck. You know what happens next? What's tomorrow, Bramo?
Tomorrow's Saturday. It's the weekend.
Let's get you to the weekend.
Have a great one.
Like from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, And by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
From New York City for viewers worldwide, welcome. I'm Manus Granny in for Jonathan Farrow. This is not a bubble. This is not a mania. So say Goldman Sachs' Peter Oppenheimer. We're going to debate that thesis over the next hour. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, stocks take a breather after closing out February at a record highs. Investors digest the latest Fed speak with more officials on deck, and the regional bank pressure mounts again. NYCB finds a material weakness in loan reviews. We begin with a big issue. New month, same story.
We've got these markets at record highs.
Record highs. All-time highs.
The equity rally. It's pretty hard to fight at this point.
I think we're going to see a broadening out.
You are seeing a broadening out to other parts of the large cap universe.
That is a good narrative for a healthy bull market.
We do see in that Goldilocks scenario some quite substantial upside still to come.
Momentum, sentiment is driving this market higher.
Confidence in growth, inflation, and interest rates coming down.
Positive U.S. growth coupled with Fed cuts, which will come even if we get a little bit of a slowdown, means that you can have a pretty positive outlook for equities.
They're reflecting pretty good fundamentals.
The aggregate measure of equity positioning does not suggest euphoria.
I don't think the valuations yet are consistent with any kind of bubble or mania.
Joining me now to discuss that debate, it is Citigroup's Stuart Kaiser and Morgan Stanley's Lisa Charlotte. Good to have you with me both. This is not a bubble. This is not stretched. This is not euphoria that's going to break. Good morning to you both. Lisa, let me bring it straight to you. I mean, those are some sage voices throughout the week. Join the narrative and define whether you're on the euphoria and it's running out of steam narrative, or you think there is miles to go before we sleep. Good morning.
Good morning, and thanks for having us this morning. Look, I think we have to be very careful about using words like mania, because you never know that you're in an exuberant mania or a bubble until you're at the other side of it and it bursts. So, you know, from where we're sitting, you know, what we need to just ask ourselves is what is driving the rally. And so, you know, what has perplexed us is that the bullish narrative has really shifted, right? And we've morphed almost uninterrupted without taking a breath since last November from a narrative that was exclusively about the Fed, exclusively about 7 rate cuts being imminent, the Fed pivot, driving positioning, to a narrative where that's completely fallen apart. Everyone's now capitulated, said maybe we only get 3 or 4 cuts this year. The Fed doesn't act until May or June, and the market didn't even take a breath. And has continued to go up, meaning that they've shifted the narrative to, okay, growth is stronger, inflation is stronger, rates are higher for longer, and I believe in earnings. And so for us, so long as earnings come through, this rally can probably hold up. But our perspective is, how do you play that stronger growth? And from our perspective, we want to play it with broadening. So we've liked the equal weighted S&P 500. We've liked stock picking. We've liked value. And we want, our clients to own something more than just the market cap weighted index.
And we will come back and discuss how we get that breadth in just a moment. I would actually add the caveat to both Binky and to Peter Oppenheimer. They did talk about earnings growth of around 8%, but I take your point about we hardly took a breath. Good morning, Stuart. You say the debate for us in this market is, I love it, it's either Momo, FOMO, or oh no. I hope you're going with Momo. Good morning.
Good morning, Mattis. How you doing?
So which is it for us? I mean, we've got momentum and I've got FOMO, but you do caveat with oh no. So to this point, from the voices that we've had this week, do you believe that we are in some kind of manic episode, or will it endure higher for longer?
Yeah, Matt, we haven't really been in the bubble camp, to be honest. I think Lisa made a few really good points on that. From our perspective, coming into the year, we were very much anchoring ourselves to strong GDP growth and positive EPS growth as the reasons to be long equities. And frankly, I think if you came into the year thinking you needed 7 rate cuts, then that was actually obviously going to come alongside a significant slowdown in growth, which we think would have been disruptive for markets to begin with. So, we don't think we're in a bubble. We don't think this is a sign of mania. We think this is a sign of very strong economic growth and EPS that's going to grow probably double digits this year, and that allows you to remain long equities. Obviously, the inflation data and potentially some of the event risk from the regional banks is worth watching, but big picture, hard economic data, soft economic data, and EPS growth, I think all justify continuing to stay long equities.
Okay, and I think that is the building and baseline consensus. We have no shortage of Fed speak this week, and here's the latest from San Francisco Fed President Mary Daly.
We want to avoid holding on all the way to 2%. They're putting policy very tight and then cause an unnecessary downturn. We are agile, and we're sitting in what I call the ready position. We are ready to make moves and adjust as the data demand us to do. And I think right now the economy and policy are in a good place to do that.
And she goes on to say there is no imminent risk of the economy faltering. So strong and bullish narrative there from Mary Daly. Mike, good morning. We have more Fed speak to go before we sleep, but set the table for us.
Yeah. Well, let's go back a little bit and set the table, Manus. Take a look at the month of February, because the last Fed meeting was January 31st, so it's kind of a neat calendar activity. You can see the beginning of the month we had the jobs report, and the 2-year yield jumped up, and then in the middle of the month we had the CPI, and the 2-year yield jumped even higher. And ever since then, we've seen volatility go out of the market, basically because everybody is singing from the same page. And Mary Daly was doing the same thing yesterday. They're all saying, basically, we have gotten to the point now where we probably don't need to raise rates, but we're not ready to cut rates, and we'll maybe cut rates later this year, but we have to watch the data, yada, yada, yada. So it's a sort of a kind of unique, all-united chorus here from the Fed. As you mentioned, we do have a couple of Fed speakers to go, but it's really next week that matters, because next week we have another busy eco calendar, but we also have that man in the middle there, Jay Powell, on Wednesday, and what he says is really going to matter. Now, he did speak in February, right at the beginning when he was on 60 Minutes, but now we've had all this data, the higher inflation numbers, the strong job numbers. We'll find out what he thinks of that on Wednesday and Thursday when he's up on Capitol Hill. We also get those JOLTS and ADP numbers, which can move markets. And of course, Friday, I think I'll be here with you for the jobs report, Manus. That's going to wrap up our week and start our February off with a bang, perhaps.
It defines the market when you break that. When you break those numbers down. Mike, thank you very much. We'll build up to the jobs report next Friday. My guests this morning are Stuart Kaiser and Lisa Shallett. Lisa, I'm drawn to what you had to say. You talk about U.S. exceptionalism, that U.S. policy of exceptionalism, and the supernova of the U.S. equity market is unchallenged. But you say there are many factors to point to a bright U.S. economic future, but valuation suggests significant optimism is baked in. Now, I want to focus on this bit. As the Fed may be at an impasse where patience, not policy exceptionalism, must rule. Can you define for me, translate what is patience, and could patience manifest itself to, as Torsten Schlock at Apollo says, no rate cuts 2024? Let's have that backwards and forwards between yourself and Apollo.
Sure. So look, I mean, I think one of the things that we've continued to point out to people is that part of the outperformance of U.S. markets relative to the rest of the world, quite frankly, for the last 15 years, has owed in large part to the aggressive activism of the Fed and the central bank to constantly accommodate with both rates and liquidity. And more recently, they've been joined with a very aggressive fiscal policy coming out of Washington, which is certainly helping liquidity and certainly helping growth. But here we are. Growth is continuing on the margin to surprise on the upside. The labor market's continuing to surprise on the upside for its resilience. And, you know, we have long been in the camp that says inflation, particularly in the super core and services, is going to remain sticky. If that's the case, the Fed really has no legitimate justification to cut for the sake of cutting. And they may need to just be patient and not intervene in markets. And so, look, we're still biased to thinking that there is a slowdown in the data in the second half, which will justify potentially a couple of rate cuts. But it is entirely possible, you know, that Thorsten at Apollo has this right. And the Fed actually does stay on hold the entire year. One of the things that's interesting is we've gone from a market that may be dependent on the Fed talking about rate cuts to the fact that the Fed is you know, confident enough to do nothing, actually being encouraging to market participants because they say, okay, the Fed's not cutting. They don't see any weakness ahead.
I mean, let's just consider the risk there that we go for no cuts, as you say, Lisa. You know, why cut for the sake of cutting? Stuart, here we are. We're going to come up to this March bumper where we're going to get new dots. And I suppose the market has now begun to countenance. We could go from 3 dots to 2 dots. But do you think that there's merit in Apollo's thesis that we could get 0 cuts this year? What would it do to your perspective on markets and equity markets? Would that deliver the breather that Lisa has referred to that we just didn't take? This is what Torsten's saying. The reality is the U.S. economy is simply not slowing down. The Fed pivot provided a strong tailwind in December, and as a result, the Fed will not cut rates this year. Rates are going to stay higher for longer.
Look, I mean, my question back to him will be why. You know, I think if you get no cuts this year because U.S. economic growth remains really strong, then I think equity markets perform just fine in that environment. I think that's largely what happened in 2023. You know, if they're forced not to cut because of upside inflation pressure, you know, that's a much different story, and I think that would read much more negative for markets. You know, I think the most important word in Daly's statement was unnecessary. And I think what the Fed told you in December was when you get core inflation down to this level, they are going to start to do a risk-reward on the inflation fight relative to, you know, creating a self-inflicted recession. And I think that's what she's saying is you've gotten inflation to a level at which they need to, you know, really understand the risk-reward around the growth side of things. So, look, big picture, if you get 0 cuts this year and it comes from growth, I think you're fine. If you get 0 cuts because of upside inflation pressure, like the data over the last month would have suggested, you know, that's a much different story. And in that case, I do think you have equity markets lower.
Okay, and of course we've got to see how the growth numbers come out and whether we get those earnings continue to rise. We've got more work to do, so stay with us for this Friday. We haven't finished yet. Stuart Kaiser, Lisa Charlotte. My guest this morning on markets. Let's go under the hood for the opening, ahead of the opening bell, I should say, with Abigail Doolittle. Abby, what have we got?
Well, Menace, we have some real bright spots and we have some real low spots. Starting off with a big bright spot, we have the shares of Dell surging. This after they put up a big earnings beat, sales beat, both driven by technology related to AI and their infrastructure unit. They put up $9.33 billion worth of revenue in that unit, a big beat, up 134% over the last year, but the rally continues. Apple, not so much, down 0.6% as Goldman takes the stock off of its conviction list. It's worth noting this stock is now flirting with an official correction from last year's high. And then we have New York Community Bank Corp down 21%. This after the company flagged issues around its CRE loans weeks ago, and of course put up that very disappointing quarter relative to building reserves. Now disclosing they have discovered quote unquote material weaknesses in how it tracks loan risks. They're also changing CEOs effectively. The stock down nearly 75% from last summer's high. To end on a bright spot though, Menace, there is breaking news right now. Vista Outdoor is climbing 8%. The Wall Street Journal saying that MNC Capital has made a $35 per share all-cash bid for Vista Outdoor. Again, that stock up about 8%.
Yeah, this whole M&A feature of 2024 is really beginning to ramp up. We'll track those prices at the open. $35, all cash bid. Abby, thank you very much. Good work coming up. It is another chapter in the New York Community Bank saga.
The prior management team unfortunately had to go. I think we had to have the change in management to have a confidence change. The largest individual shareholder is Sandro Danello. He's taking charge. He's making very swift changes.
The bank flagging material weaknesses and replacing its CEO. The conversation ahead on Bloomberg. Good morning.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Prior management team unfortunately had to go. I think we had to have the change in management to have a confidence change. The largest individual shareholder is Sandro Danello. He's taking charge. He's making very swift changes. This is all healthy to get the company where it needs to go. They're now $115 billion. They have to be part of the new world order that is a regional bank under new guidelines. And yes, the regulatory world is changing quickly, but you have to adapt and you can't sit still.
an optimistic take on the NY Community Bank. Now, traders are looking a little bit more pessimistically at the stock this morning. The pressure is there. The bank announced an abrupt leadership change and identified, as they refer to, material weaknesses in how it tracks its loans. Katie Greifeld is with me. Katie, define the material insight that they discovered.
Yeah, there's a lot of concern here, of course, about what else is under the hood. Just to go through some of the flurry of headlines that we got yesterday in a filing, of course, New York Community Bank said that it discovered, quote, material weaknesses in how it tracks loan risks. It also wrote down the value of companies that it acquired years ago. It took a $2.4 billion goodwill impairment, and it also announced that Alessandro Dinello will become the bank's new CEO. Of course, he replaces Thomas Cangemi. And remember, Dinello was appointed executive chairman last month. Now he's officially taking the reins. So the reason the stock is plunging right now is because Wall Street doesn't really know what's next here. If you go back to the end of January, when NYCB said that it was stockpiling cash to cover potential loan problems, of course, that really set off fears about the state of regional banks, the state of commercial real estate, and investors really have been on edge since. So remember, when it comes to New York Community Bank, it's a major lender to New York apartments. Its largest real estate exposure comes from about $37 billion in apartment loans, with almost half of that backed by rent-regulated complexes. And of course, the real fear here is the unknown. You take a look at Piper Sandler this morning, cutting the recommendation to neutral, saying, of course, that they thought that the bad news was behind this company, but the latest disclosures, quote, give us concern that there could be more issues coming down the pike, and you certainly see that reflected in shares this morning.
Indeed. Katie, thank you very much. Katie Greifeld on the very latest there. Stuart Kaiser and Lisa Charlotte are my guests this morning. Stuart, when I look at this single lane story this morning in regional banks, again, we're told it's idiosyncratic, it is not systemic. They're backed by apartment lending. Yes, they have oversight issues. When I talk to the market and when I understand what is the flow, how do regional banks, I mean, have people already exited regional banks per se, or how do they act as a hedge, perhaps against slowdown or a broadening of risk?
Yeah, Matt, I think from my point of view, people were trading regional banks as a little bit of a soft landing proxy, coming into the year. It's an area of the market that benefits from strong economic growth, and it's an area of the market that would have benefited, from lower yields. I think early in the year, because yields were lower, but it was alongside stronger growth, people were happy to kind of keep that risk on. But, I think the New York Community Bank news just reintroduced this sort of credit and real estate risk aspect. And, if you're a macro investor, you were not buying the regional banks because you had a strong view on that. You were buying it for the growth and rates, rates exposure. And I think for that reason, that event kind of took a lot of the more kind of macro investor base out of the space. And, regional banks, measured by the KRE, for instance, are down, 8 to 10% year to date, depending on when you measure it from. So I think the news is significant in that sense, that it reminds people that these risks have not been resolved. And it sort of, takes the legs out of this sort of soft landing narrative around regional banks.
And I think maybe, Lisa, this could be the breather. If this grows in any way or broadens out, maybe it's the breather or the jolt that will bring us a pause in the equity market. Lisa, I want to drill into this default narrative at the moment. I find a very interesting narrative, which is the breadth of defaults. It's not actually in the big 100, and there's a heck of a lot of banks in the United States of America, so it's not in the top 100. Delinquencies are rising. They're rising in the smaller banks. It is the shape and direction of travel in delinquencies that I am interested in, and I'd like your take in terms of finance exposure and concern about those delinquencies from a broader market perspective.
Yeah, so look, what we have to remember is that the yield curve has now been inverted for, close to 18 months. I mean, it's an extraordinarily long period of inversion, and that puts extraordinary pressure on banks. And, the regional banks have, gone through their issues with regard to how they were funding themselves. We know the issues from last year with regard to the Treasury market. The latest concerns are their exposure to local commercial real estate woes, and that's legitimate. And now you bring up, the issue about default rates rising, both around consumer exposure and, small and mid-sized business lending exposure. And look, this is the one part of the economy. We talked about how higher for longer might be okay for the large cap market because they see that as confidence in growth. but higher for longer rates and inflation are not going to help the parts of the market that are exposed to the regional banking system. And that is, some of these smaller local family-owned businesses, some of the unprofitable small businesses, some of the commercial real estate and local real estate businesses. These are folks who are very dependent on rates, and the timing of a rate cut matters to them. And this yield curve inversion is going to continue to be kind of a slow burning pressure on regional banks.
Okay, Lisa, thank you so much. Stuart, of course, we are aware of your momentum trades. It's long industrials, tech, and financials. But the headline of the day, team, is maybe the risk, according to Apollo, of no rate cuts. Let's all go home and think about that for this weekend. Stuart Kaiser, Lisa Charlotte, my guest this morning. Coming up, your morning calls. Let the good times roll. We'll catch up with Troy Goetsky of FS Investments on why he sees a rosy picture for the U.S. economy. Good morning from New York. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Time for your morning calls this Friday. This is what we've got from the street. First up, Piper Sandler downgrades New York Community Bank to neutral, growing increasingly concerned about the mounting question marks. Up next, Goldman Sachs removes Apple from its conviction buy list, saying the markets continue to focus on the company's slowing revenue growth and indeed price cuts in China to try and offload the latest iPhone. Finally, Bank of America raising the price target for Eli Lilly to street high $1,000, seeing further upside for his diabetes and obesity products. Coming up on the show, we catch up with Troy Goetsky of FS Investments around the opening bell.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Why should somebody want to be in the pharmaceutical industry? Why not go into something sexy like private equity?
In the end, what we do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Which house on Wall Street do you believe? Goldman Sachs were with me this morning saying this is not a mania, this is not a bubble, there's miles to go, earnings will grow by 8%. We're stock bid this morning. And then you have Lisa Shallett of Morgan Stanley saying, didn't draw a breath in this bid up. They've had outflows this week. BlackRock, Grayscale, go figure on the Bitcoin trade. But that is all about the flow show into the ETFs. And it's a one-way street for BlackRock. More on that later in the show. Bitcoin up 1.56% at 62,000. Mike Novogratz, the evangelist of Bitcoin and blockchain, says we're in price discovery mode. We'll settle back to the low 50s, $50,000 before you accelerate again. Yields are flat at the moment. Torsten Slok at Apollo floats the new headline on Bloomberg, the possibility of no rate cuts in 2024. Sleep on that for the weekend, come back and trade. Crude trades up 1.62%. OPEC Plus expected to continue with their cuts of of 2 million. The time spreads are tight, and that tells you something about the physical market. But we're back to stocks. It's 9:30 and 43 seconds. Dell is on the move. The share is at a record high after posting better than expected results fueled by surging, you got it, AI demand. Abigail Doolittle will tell me where the AI is in the DELL.
Well, it is certainly in the deal and in the report and in this stock surging 35%. Its best day ever since re-going public, re-IPOing back in 2018. So it is soaring on a big beat, top and bottom. The bottom line was very impressive. They put up $2.20 on adjusted earnings. That's 28% better. That has to do with the $9.33 billion worth of revenue that they had in their infrastructure unit. That is that AI technology. So we now have Dell Technologies becoming, it seems, one of the AI proxies, one of these stocks that's really going to be associated with AI, especially when you consider that into today, this stock up 134%. So this report did not disappoint, despite the fact, and this is interesting because when I think of Dell in some ways, I think about Dell computers, the more traditional technology, commercial and personal PC revenues dropped 12%. So this AI technology, the potential there is more than making it up. And in addition, they raised their dividend by 44.5 cents per share. So again, we may be looking at another AI proxy. And then very quickly, Manus, just moments ago, or I should say about 15 minutes ago, we broke the news that Wall Street Journal is reporting that MNC Capital is making a $35 per share all-cash bid for Vista Outdoor. That stock up about 7% right now. Its best day since February 1st. They make outdoor products and sporting goods pretty close to the bid offer of $35, suggesting maybe that there is optimism that this deal will actually happen.
Yeah, well, the M&A, ladies and gentlemen out there of Wall Street, are licking their lips. Some deals are flowing in. Abby, thank you very much. From leaders to laggards, shares in NY Community Bank, they were getting hammered in the pre-market, identifying material weakness in how they track their loan reviews. Now, the company is also announcing changes in the C-suite. Katie Greifeld is with me. Katie, no reprieve as we go through the opening rotation.
Not at all. The stock really plunging this morning, and it's the material weakness in its reviews that really seems to have analysts on edge right now. But let's go through all of what we learned yesterday. Of course, NYCB said in a filing that they discovered, quote, material weakness in how it tracks loan risks. It also wrote down the value of companies it acquired years ago. And like you mentioned, of course, it announced that Alessandro Danilo will become the bank's new CEO. Remember, the drama first erupted in January when NYCB said that it was stockpiling cash to cover, of course, potential loan problems. Wall Street really has been on edge ever since, and now it's worried about what it doesn't know. You take a look at what the sell side is saying this morning. You do have Piper Sandler saying that the latest disclosures, quote, give us concern that there could be more issues coming down the pike. Of course, we heard something similar from Citi saying that the main issue is that management statement of material weakness in its internals controls with respect to a key foundation of its business model. You add it together, and of course, the outlook is very pessimistic right now. The stock continuing to accelerate to the downside, currently down about 27%, Manus.
Okay, Katie, thank you very much. Katie Greifeld on NY Community Bank Corp. Very much under pressure. Now, some of the issues with the paperwork over at Beyond Meat, the company failing to file what's called a 10K report by February 29th, the deadline, due to technical difficulties, we're told. Simone Foxman can give us the details. What have we got, Simone?
Yeah, Manus, well, the good news is that Beyond Meat has now filed in the past hour its 10K, but it wasn't able to squeak it under the wire in that February 29th deadline. 10Ks, as many of you know, is these forms that lay out the risks, the challenges, the goals for any company. They have to be in by the end of February, but U.S. rules do permit an extension to March 15th. So Beyond Meat did file this. It hit its highest on a share basis in the past 6 months yesterday after a bunch of earnings enthusiasm earlier this week, with fourth quarter sales coming in pretty positive, looking for a path to profitability this year. So shares not really moving too much in reaction to this, a little bit higher now that it's gotten that 10K in. The other name that hasn't filed its 10K yet is Archer Daniels Midland. This is a U.S. agricultural trader. It has delayed publication for a different reason. It's doing an internal probe of its accounting issues having to do with its nutrition unit, according to sources. And in January, announced it's put its CFO on leave. So this morning said it anticipates reporting material weakness in the company's internal financial reporting practices, but did say, and this may be the cause of some of this enthusiasm in the shares this morning, that this won't impact consolidated balance sheets, statements of earnings, and cash flows. Shares are down about 25% year to date, shares are down 25% year to date, but up about 1.5% this morning, Manus.
Simone, thank you very much for the very latest on those. Let's turn our attention to Apple, because it's been a heck of a week. Third day of declines. Goldman Sachs removes Apple from its conviction buy list. The concerns are around its revenue growth. Ed Ludlow is with me on this. I mean, they remain as a buy, and they have a price target above this level, but we've had price cuts, Ed, in the iPhone. We've had a lot of issues this week.
There's a difference between removing a name from your conviction list and then actually lacking conviction, right? They reiterate the buy. They've actually raised the price target on the stock to $232 from $223. But I guess that what Goldman's doing is amplifying the concerns that are out there, right? The reporting that on some third-party platforms, for example, Alibaba's Tmall in China, the price of an iPhone dropped about $180 this week, which signals some weakness in what is a critical end market. But the language that Mike Ng uses from Goldman is that those growth narratives, the focus of the market on slower product cycle and the problems in China is masking the idea that the ecosystem is strong. I find that really interesting because look at our research from our Bloomberg intelligence analysts. This week, Mobile World Congress is going on in Barcelona, and what you saw from many of Apple's competitors, particularly Chinese domestic handset manufacturers, was them demonstrating how to use generative AI on a handset. Apple has not yet done that. But what Anurag Rana from Bloomberg is writing about is that, I don't know what generation iPhone you have, Manis. I always have the latest iPhone or Samsung, but 43% of all the handsets around the world, according to Bloomberg Intelligence research, are the 12 generation or older. And they see real upside because an upgrade cycle could be driven if Apple gets its act together and says, look, we do generative AI, it's just not where we focus so far. I think there's probably still some jitters out there from the reporting in the week as well about the end of the Apple Car project after a decade of working on it.
Okay, Ed, thank you very much. And you're right, the nuance between conviction and buy is wide. Troy Goetsky is FS Investments. My guest says this: let the good times roll. The data is truly painting a mind-bendingly rosy picture of the US economy after a horrific pandemic. Troy, good to have you with me. Mind-bending, bullish statement. I mean, there's no hesitancy in you this morning, is there? Good morning, Troy.
Good morning. Good morning. Yeah. No, and remember, there's a difference between the U.S. economy and financial assets, which we have to remind people of to some extent. But yeah, look, you think about the path we walked through. It looked like a very reasonable probability that we'd enter a recession sometime in late 23, particularly when banks started to fail. You had a massively inverted yield curve, which Lisa was discussing earlier.
Yeah.
You had money supply shrinking. But if you look where we are today, I mean, obviously consumption's slowing, but the labor market's still very, very tight. It's very hard to identify a catalyst that would lead to a wave in layoffs, right, which would weaken the consumption power of the consumer. And government spending is trending higher. A lot of the stimulus is in the pipeline. It has yet to be spent. Labor hoarding is a real thing. So, the good news for investors is that the probability of recession has dropped dramatically. And so now it's really time to figure out how to put those cash hoards to work and what type of growth exposures do you want to go for and what type of income exposures do you want to go for?
Well, what kind of growth exposures do you want to go for? I can understand, and I've had a lot of verification on Mag 7 in terms of margins, in terms of sales.
Yes.
So where else is the growth narrative for you?
Yeah, so certainly you should have some exposure to market cap weighted indices. Definitely fade the whole equal weight, fade the value catch up to growth, because those are wonderful companies. But other than that, if you look at your choices, the area that we've liked for several years now is middle market private equity. Because there you have smaller companies where it's easier to grow EBITDA from 25 to say $75 million. The exit strategy is much more transparent, whether it's M&A, smaller IPOs, or selling to a mega cap LBO shop. You have far less leverage, which is critically important now because debt service coverage costs have gone up a lot as interest rates have risen. So you have less of a drag on free cash flow, and valuations are cheaper. And then on top of that, there's a wonderful secondary opportunity taking place now because institutions got a little bit over allocated to private equity, and the payouts from those vintages have slowed dramatically as capital market activity slowed. So that's been for the past 12, 18 months our favorite spot for growth other than, mega cap tech. And that's probably your best option, but you have to trade off liquidity to some extent. Obviously, these are not liquid positions like you have in stocks or cash.
No, we had EQT with us yesterday talking about those payouts and trying to get the investors to roll up for new investments. Can you just tell me where your view is on cash? Because we've now got this new debate. Apollo putting out there into the market the risk of no rate cuts this year. And yet I look at money market assets, Troy. They are at a record. And institutions led that flow. Where does cash play at all into your thinking?
Yeah, so a great observation. I mean, you look at the cash hoards that have been built. That has really been the mega trend in this cycle, right? The big winner this cycle has been cash. Everything else has been details. So we've been articulating folks should focus on Northwest Quadrant strategies and the efficient frontier, less risk, decent return. Cash obviously fits there. But over time, right, you having some of that eroded from inflation, obviously. And we still think the Fed is going to cut slightly this year. So it's interesting to watch the narrative change. But now's the time to think about deploying that. And when you think about how you're going to deploy it, you probably don't want to move to very high risk investments immediately, particularly given where multiples are in U.S. equity markets. So you can think of things like senior secured commercial real estate lending, private credit, middle market private equity. Those have far less risk than, say, liquid equities or fixed income, and you can meaningfully increase your return. So now's the time to think about how to deploy that cash, not only for individual investors, but also institutions.
Now, you've got a bit of a dig at the fixed income people out there. You say chance, as they call it in Monte Carlo, is to the perma-bearish fixed income managers. I mean, should they just throw in the towel in terms of rate cuts, dramatic slowdown in the U.S. economy, and tacitly accept that we're going to have higher rates in the medium term? And when I say medium term, actually short term, I should qualify that, and keep it to this year.
Yeah, it's really been unrealistic for a while. I mean, that the Fed would cut aggressively anytime soon. I mean, remember, coming into 2023, the bond market was pricing in cuts. And I totally get it. Everybody talks their book. If you're long a bunch of duration, you're actually perversely rooting for a U.S. recession, so the Fed will cut and you'll have some price inflation. But the reality of the situation is, coming into this year, the most we could see the Fed cutting was 50 to 75 basis points. And the data's continue to be strong. I'd be very cautious, though, about opining that the Fed's not going to cut it all this year, because real rates have gone up. They're positive now, whereas most of the post-pandemic period, they've been negative. So it does make sense for the Fed to take a little bit of the pressure off in terms of the front end. But that still doesn't mean you have meaningful upside in fixed income, because naturally the curve should normalize. And when we look at the 10-year today, even in a recession, we think more like 3.25% to 3.5%, as opposed to 2 to 2.5%. And that just means you don't even have that much upside in a recession, and recession's not happening anytime soon. So you just have to be realistic in fixed income that you're certainly earning more income than you did 3 years ago. The risk reward is obviously significantly better, but it's not like you have this great return potential. And in the meanwhile, just like we've seen happen this year, you can suffer some degree of mark-to-market losses from another bear steepener. Either way, the curve is going to normalize. We just think bear steepeners are more likely than bull steepeners in the short term.
Okay, Troy, we'll keep that in mind. I'll leave you with this thought from Barkham, where he's just been on TV. He says the Fed is not in a battle with markets. We're not trying to have swagger against the market. I love it. I mean, you couldn't... markets and the Fed are like two clashing titans, aren't they? Troy, thank you very much. But eventually, the Fed wins. Troy Goetzke of FS Investments coming up on the show. Shutdown averted for now.
It's good we're not shutting down. And now let us finish the job of funding the government so we don't have to do this again.
We'll have the details on those negotiations and the next looming deadline right here on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we've provided ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
When we pass this bill, we will have, thank God, avoided a shutdown with all its harmful effects on the American people. I thank my colleagues for working together. It's good we're not shutting down. And now let us finish the job of funding the government so we don't have to do this again.
Congress approving temporary funding to avert a partial shutdown. Now, the interim measure moves to the next deadline, March 8th. President Biden writing in his statement, quote, "I want to be clear. This is a short-term fix. In the days ahead, Congress must do its job and pass a full-year funding bills that deliver for the American people. Can they? Will they? Is there the appetite? Or is there political obfuscation?" Anne-Marie Hordern can divine that for me. Anne-Marie.
Well, they're kicking the can down the road, which we've seen them do not just once, but this is the fourth time, at least, they've been doing this. So what they have to do now is get these appropriation bills done. I'm less concerned with March 8th. March 22nd is going to become incredibly challenging. The kind of appropriation bills they need to start funding, and then these departments have to deal with defense, homeland security, and what you are seeing is Republicans try to look for limits on some reproductive services, and also they want to change immigration laws. So then the policy is going to get very difficult when you start looking at how they're going to fund these administrations, part of the federal government. One thing we should note, Matt, is everyone was talking about whether or not Speaker Johnson will lose his job. 97 Republicans voted against this stopgap funding measure, but yet a lot of them came out and they said, look, this is what Washington has to do, and for now, his job is safe. But there's going to be a lot of challenges upcoming.
Where are the biggest stumbling block, roadblocks to making a more progressive deal, a longer-term deal?
Well, we heard from Republicans that they don't want to do these omnibus deals where you just put everything into one package. They want 12 different appropriation bills. It looks like they're getting closer on some of these, that the deadline was supposed to be the 1st. It's now going to be the 8th. The issue is going to come when it comes to March 22nd. And we have to remember, if they don't fund the government, the deal that was done under former Speaker McCarthy and President Biden would be a 1% cut across the board on where federal spending is right now. So potentially you have some Republicans who want to drag this out to get to that day.
Okay, well, we're counting down. Let's see what the votes come in. And, of course, next week we have State of the Union. We have Super Tuesday. You're going to be busy, Ms. Hordern. Thank you very much, Anne-Marie Hordern, following the political junkets. We have some breaking PMIs crossing the Bloomberg Terminal. Abigail Doolittle is here to break them down. Abby.
We certainly do. We have lots of information to break down here, Mana. So relative to the S&P Global U.S. Manufacturing PMI, the final reading for February coming in at 52.2. This, of course, is an expansion territory. Anything below 50, contraction above is expansion. The survey had called for the preliminary 51.5. So this is a little better than expected. Strong for the economy. Not seeing too much of a reaction relative to rates, although they are slightly higher. So maybe that's a little bit of that strength there. As for other breaking news, New York Community Bank Corp, after that disclosure around material weaknesses being down, shares had been halted for a period of time. They're now trading again at session lows, essentially down 27%. There's a slew of headlines out, including the idea that the material weaknesses are not expected to impact 2023 revenues. The allowance for credit losses isn't expected to change anytime soon, is one of the headlines. So it seems as though they are trying to convince investors that they are really taking care of the situation. But with the stock at session lows, investors really looking past this fear and uncertainty ruling as we have a change in the C-suite. And then not breaking news, but news that we try to do at this time every day. Sectors. From a sector standpoint, we have the S&P 500 up ever so slightly. We have a few sectors higher. Energy, the best sector, up 1.3%. This, of course, in sympathy with oil, up about 1.5%. The worst sectors, utilities down 1.6%. Yields are down. Of course, yesterday, though, also Xcel Energy revealed that they disclosed in a filing that a law firm, an unnamed law firm, is asking them to keep a utility pole that could be responsible for the big wildfires down there. That could be a piece of the weakness. On the week, we are looking at a number of the sectors trading higher. The home building sector up 1.3%, and then these are some of the subsectors, Manus. That KBW Bank Index, that's the one we really want to take a look at. The regional bank index down 2.8%, and of course, much of that driven by New York Community Bank Corp.
Absolutely. Great to get those headlines in, and the oil market trades higher, giving you that sector-wide performance. We're going to take you through the market-moving events for the rest of your day on the Trading Diary in just a moment. Beautiful day in New York City. Good morning.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Trading Diary, what's ahead of you? Well, we have University of Michigan consumer sentiment at the top of the hour, plus the ISM manufacturing. Fed speak throughout the day. Waller, Logan, Bostic, Daly, along with Kugler. Next week, all eyes on Super Tuesday. Politics features high on the agenda. Then you have Chair Powell testifying on Capitol Hill. Wednesday and Thursday, let's see what he has got to say. We haven't heard from him post 60 minutes. Let's count down to the open for this week. It has been manic in parts for some of the stocks. Dell is on fire. New York Community Bank Corp under pressure as we finish off this Friday. Thanks for being with us.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rates World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City. It is Friday. We made it. Alex Steele, Paul Sweeney live here, and we're also on YouTube, so head over to youtube.com, search Bloomberg Podcast. Lots of economic data. We're going to break that down for you in just moments. We're also going to talk about regional banks. Do we have a regional bank problem, or is it just in New York City with this NYCB thing? So we're going to break that down as well. We're going to check in with Anna Rathbun, CIO at CBiz Investment Advisory Service, get her look on these markets. All that's coming up here in this first hour. Let's kick things off here in the 10 o'clock hour with Mr. John Tucker, Bloomberg Business Flash.
All right, this market report being brought to you by Interactive Brokers. IBKR's redesigned Fundamentals Explorer provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit ibkr.com. We are data dependent. Let's start there. University of Michigan sentiment survey coming in lighter than expectations, 76.9. Survey by Bloomberg of economists was looking for 79.6. I'd like to focus on the inflation expectations data 1 year out. That coming in right at 3%. That was expected, same as last month. The 5 to 10 year inflation outlook, again, right on target with expectations, the same as the previous month. And then you're going to take a deeper dive, so I'll just hit this lightly. The Institute for Supply Management ISM Manufacturing Index. This is the smaller part of the economy compared with services. That is coming lighter than expectations, lighter than the previous month, 47.8. We were looking for 49.5. Major stock averages, they are little changed. After the S&P 500, the NASDAQ, and the NASDAQ 100 closed at records. 7 of the 11 major industry groups in the S&P 500 were lower. Meantime, Steve Whiting at Citigroup Private Bank remains overweight equities.
A lot of other good things are happening in the economy. We're raising our economic forecasts, raising S&P EPS forecasts, and seeing industries that have been weak for the last year and a half bottom out and begin a recovery. They won't do as well as Mag 7 in terms of EPS gains, but hey, they're at a very different valuation.
Right now, the S&P 500, 5 points higher. That's up 0.1%, 5,100. So that's a intraday record. S&P 500, the NASDAQ right now, NASDAQ 100, 63 points higher. That's up 0.4%. The Dow Jones Industrial Average, 104 points lower. That is down 0.3%. 10-year yield unchanged right now, 4.24. The 2-year, that is down 2 basis points at 4.58. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, thank you so much, John Tucker. But I should say we did see, Paul, a spike once we got the ISM and the Immerse in the S&P. Like, I get we're only up 0.1%, and definitely buying coming into the front end. It's like, buy everything. It's okay, the Fed's going to cut. Not at all what Torsten Slok was saying.
No, Torsten Slok, we just had Torsten Slok on saying the economy's better than expected. Well, these numbers don't show that.
They don't. So let's kind of understand what's going on. Tim Fiore is chair of the Institute for Supply Management. So he's the ISM guy. So he does all the stuff. He does all the surveys. He knows the things. And just to recap, ISM manufacturing coming in light at 47.8. The new orders, though, slipping below 50. All right, Tim, what happened? What's going on?
So, Alex, it was actually a pretty good month. So what's actually happening on the number side is seasonal adjustment factors. So we got a huge benefit in January from seasonal factors, and we got a huge deduct in February from seasonal factors. If you look at the raw numbers, we're actually positive in February compared to January, which you would normally expect to see anyway. So overall, you know, I go through the 10 sub-indexes. I categorize them as positive, negative, or mixed for the month, and I determined all of the sub-indexes were positive for the month. So let me support this whole thing on the demand side, because the new order number is the one that's going to really flash out at people. By far, the majority of our comments around softening demand is decreased in half. So many fewer panelists are commenting about softer orders, which is a positive thing. Our sentiment around future demand is still running at about 2 to 1. You know, we peaked at 10 or 12 to 1, you know, many months ago, but 2 to 1 still says we have a predominant amount of people saying that things in the future are going to get better. You know, I've been tracking the percent of respondents that are below 50 industry sectors and the ones that are below 45, which is a real warning sign. So I think last month under 45, we were 27 back in January, 27% of manufacturing was contracting at 45 or less. This month is 1%.
Wow.
And then on the overall contraction under 50, last month was in the range of 65. This month we're in the range of 40. So overall, we're moving in the right direction. This is going to be a slow recovery. I think the month of February indicated that, yes, January was a pivot month. We're starting to grow again. The headline number isn't showing that, but the detail underneath supports it for sure. So I think demand is coming back for sure, especially with the raw number being up.
Okay. So how about, so Tim, for us folks that just kind of look at the headline number, when am I going to see a ISM manufacturing number north of 50? When do you think we're going to see that and see a little bit of growth in the manufacturing economy?
I think it's very possible in March.
Oh, okay.
I've been saying that for the last 3-4 months. It's very possible that we could see it over 50 in March. You know, the seasonal factors are an interesting thing. I'm a big believer in seasonal factors, but we had 3 years of no seasonality. And those 3 years are now factoring into our seasonal adjustment factors. You know, we had, for instance, on the new order side, we actually upped the January new order number up 4.2 points in January, and we're now deducting 4.3. So there's some real volatility going in here because of what happened in the pandemic. These are carryover effects. But so you look at both elements, look at the seasonal factor, look at the non-seasonal factor. We're definitely heading in the right direction. And I think the other thing here is on the production side, we're generally stable to the prior month. So revenue continues to be stable, which is good. We continue to take headcount out to match the future projections, at least within the next 6 months. We're running at about a 1-to-1 hire to force managed ratio, with half of the force managed activity being layoffs. So people are a little bit more urgent in eliminating the headcount compared to where they were in September, October.
Yeah,
I think that's all positive. And then for the first time in many months, I think 16, the supply base is now stiffening up. For the first time in many months, we've now gone to an environment where the suppliers are struggling to deliver. So that's all positive. It means demand is aggregating at the lowest level, and we're now starting to feel the impacts of it.
So this is why we love having Tim on, because you look at the headline number and we're all like, this isn't good here. And then we get the idea and we get the real data behind those numbers. So maybe when Torsten Slok says the economy is better than expected, maybe that's true. Tim, I know you're not an economist or a Fed official or Torsten Slok, but is the economy better than we think?
Well, I think, Alex, you and I have talked about this for many months now. Back in the August timeframe, I think in September, I came out with the declaration, I think we're in the trough, and I think we've been in the trough since August. The thing I didn't have any insight into is when are we going to climb out of it? Then we did our forecast back in December before Chairman Powell released his predictions on 2024. The most important one being I'm pretty much going to cap out increases. And then by the time we get to 2026 sometime, I might get to the 2%. So at that point, we already had a very positive forecast for 2024, and that just provided really good tailwinds to help us through. And then, last month I said, I think we've now started to climb out of the trough, and I think this month supports that. It's unfortunate that the seasonal factors are so fluid here, but that will all stabilize. March and April are really strong manufacturing months. We probably will have significant seasonal factors to overcome. I think, like I said, we're not on a huge ramp up here in terms of expansion. It's going to be slow and gradual, but we're going to be expanding nonetheless. So I think we'll probably break the 50 mark in March, April for sure.
Hey, Tim, any particular industry out there leading the way, or is there any industry kind of holding back this U.S. manufacturing?
Yeah, thanks, Paul. So, I mean, the one I've been watching for 3 years now is chemical products coming back to an expansion mode because they support the other 17 industry sectors. Chemical products is positive. It's expanding at about a 51, 52 in the month of February for the first time in many, many months. But we've had 5 or 6 months of improvement in chemical products. So that just continues to support the story. And then also in the month of February, fabricated metal products, which is another feeding industry sector. They generally don't sell anything direct to the consumer themselves. They sell it to other companies that then convert it and sell it. That's one of our strongest industry sectors for the month of February, too, in the positive territory. I think the number was 51, 52. So 2 of the big feeder industry sectors that support growth overall are in the positive territory. I think that's a very good sign. Transportation has gotten a little bit weaker than it has been. We're still expanding at a 50 and some change, okay? Food and beverage is contracting. It's probably, of our big 6 industries that we follow, it's the one that's probably the weakest, but I've come to learn that there's a real seasonal factor in the food and beverage industry, and we're at the bottom end of that seasonal factor now. They did really well in Q4. They've done really weakly in January and February. They expected to. That's our number 3 industry sector. So I would expect by the time we hit April, that's going to come out of it's going to pass 50 and move on, and that supports the whole PMI expansion over 50 in the March-April timeframe.
Hey, Tim, thanks so much. You know what? I'm going to give you an unsolicited room rater here. I mean, your room rater in the background, it's fine. But the fact is, you're in Miami, Tim. We should have the background be like the ocean or your yacht on the intercoastal waterway. So if you could work on that'd be great.
It's even better. I'm in Jupiter.
There you go. That's what we're talking about. Golf course then. Tim Fiore, thanks so much for joining us, Chairman of the Manufacturing Business Survey for the Institute for Supply Management. Again, headline numbers not looking so great, but if you go under the surface, Tim's suggesting there's some strength out there. So I appreciate his time. Let's go see what's happening in the marketplace. I'm looking at the S&P 500. We're up about 0.2%. The Dow's off fractionally. The Nasdaq's up about 0.4. So it's a mixed day out there for sure. Maybe the market's trying to deal with some of these ISM data points. The UMISH came in a little bit weaker. We'll see about that. Let's go to Norma Linda. She covers all of the markets for Bloomberg News. She joins us here in our studio in New York City. Norma, what are you looking at today in the markets?
Well, happy Friday. Let's take a look at Hewlett-Packard Enterprise. That's ticker HPE. And we do know that this is focused more on servers, whereas HPQ, which recently reported, is more focused on the PC side of things. But we are seeing these shares making a bit of a comeback after being down more than 5% earlier. HPE said that it cut its outlook for sales growth and profits. And of course, we did have the CEO join us on Bloomberg Radio earlier this morning saying that the company is working on new use cases with AI, as well as saying that Juniper, its recent acquisition of last month, will be a terrific addition. But the company did narrow its forecast, its adjusted EPS forecast for the full year. Some of this due to that cooling demand that we're seeing for networking products.
Yeah, we talked to him on TV also. I mean, that'll play out later on in the 3 p.m. hour. I mean, I was just really struck, like, Dell has a lot of AI stuff, and they're not having the same kind of issues. Same with NetApp. So I just wonder, is it HPE's just behind, and they're playing catch up, and that's why the shortage is really there? I mean, I'm wondering.
Well, on the Dell story, the stock's up. You'll tell us a gajillion percent here, but I was surprised. I didn't think it was that much of an AI play.
Right.
Because I'm thinking Dell PCs, that kind of stuff, but apparently their server business is seeing a lot of difference.
And so it's funny seeing it here on this flip side when you look at the contrast here. As you mentioned, Dell is up. It's soaring as much as 39% this morning. That's its biggest one-day gain on record, as well as it touching its highest level in history.
I think a lot of people are like me. They're like, oh,
right.
Dell is an AI play. Let's pour into it. I'm not kidding. I mean, you look at a stock with that market cap trading up as much as it did. Michael Dell, he's number 15 on the rich list, RICH, go in the Bloomberg terminal, number 15 at 90 billion. He's now up 30% off of that.
Just
amazing. Also, if you don't want to buy NVIDIA here, right? And then the ARM story is played out. And then,
That's a great point, too.
MicroStrategy, okay. And then, so where are you going to go? So it feels like now you can definitely go to Dell.
For sure. And if you look at the last 12 months, the stock has more than doubled. So we really are seeing people really rushing behind this company here. And of course, as we think about that AI play, that's where everyone wants to be.
And New York Community Bancorp. Does anyone want to be there? New York Community Bancorp.
But we will talk.
Right. We have to talk about the laggards here. New York Community Bancorp, those shares are plunging as much as 31%. That is the lowest intraday level since 1996. And of course, we do that. This company just said that it identified material weaknesses and how it tracks loan risks. And of course, this company and regional banks in general really in focus much of last year. But many people are concerned and considering this company's CRE exposure. But when talking to analysts, it seems as though a lot of people are saying that this may be an exclusive situation to NYCB, and so not necessarily to fret. So we are seeing a little bit of muted trading when it comes to KBW. I think that index is down about 1.4%. But we did have the company now coming out saying that material weaknesses are not expected to impact 2023 results, and that allowance for credit losses isn't expected to change. So it looks like they're kind of beating their chest here, trying to keep up as everyone's got all eyes on this company here.
Yeah, more so to Herman Chan from Bloomberg Intelligence. He's the go-to guy on this. We'll talk to him in just a moment. I'm also looking, do you guys see this? Some gambling stocks. You got Las Vegas Sands, Wynn. They're one of the worst performing stocks in the S&P. Apparently, Macau, it had a miss in terms of their gaming revenue after February, which is interesting. I wonder how that ties in, though, to their Lunar New Year and the holiday. Usually that would be a good time, right?
Yeah, I mean, I guess just relative to expectations. But, some of those names like Las Vegas Sands and Wynn are more exposed to Asia than they are to the Strip.
But you like it and then you don't. And also apparently gambling revenue in Las Vegas on that Strip fell almost 4% in January.
Really?
Yeah.
But wasn't
That's so interesting. I was going to say the Super Bowl. I feel like we were writing stories about this.
Year on year. I don't know. Don't look at me. I should go help them
I do
out.
my part out there. They get a good part of my wallet when I go out there. But it's all about, when you think about the gaming stocks, it's you got to look at the Vegas, you got to look at Asia, and then the regional U.S. market. So,
we didn't talk about NetApp, though. I'm just pairing that because this is also kind of a Dell HPE story at the same time. That stock is the best performing stock within the S&P. They actually boosted their full year earnings outlook, which was pretty impressive. They also reported their third quarter net revenue that beat expectations as well. It's the same idea, right? It's like a storage thing.
Right.
AI mix is small, but they're all headed in the right direction. I feel like it's all a similar story.
Yeah, I mean, we did see TD Cohen, one of the analysts over there, saying that things are trending in the right direction, and that storage seems to be benefiting from customers making revisions to their data architecture despite the continued budget scrutiny taking place at the enterprise level.
I mean, you look at that, the chart on this thing. I mean, it's just, another, all-time high today. But it's just, there's another stock. You look at the chart and it says, the market's telling me, here's another AI play. Just bid it, buy it. I mean, you don't even ask your portfolio manager. You just go buy it.
What's so interesting about that is that I feel like we definitely saw that last year also. Like if you say AI in your conference call, your stock went up. But then we started learning that numbers were real.
Yes.
That like you could actually book and make money off of it.
Right.
It wasn't just a theory. And it feels like it leads a lot of credence to that at the same time. All right, Nora, thanks a lot. Really appreciate Norma Linda joining us on everything that's moving at Bloomberg. But to your point, a 20% move in NetApp. Like, it's not a $1 stock.
No.
Like, Dell's an $84 billion company.
And the stock doesn't trade that way. It doesn't have any of these days where it just moves like that. I mean, it says storage, enterprise storage company. It's not a software company, but boom, it just got the AI seal of approval, and it's a 20% move in the stock, and that's it. It's been re-rated, as the kids say. The analysts come back and say, this thing has been re-rated. It's now re-rated as an AI play. You just hope to get that, and the HPE folks have not gotten that yet.
Yeah, exactly.
Yes, so that's kind of the play.
And that's a tricky spot.
Yep.
Okay, you're looking at the market. Let's take a look here. The S&P is up just about 0.2%. The NASDAQ up by 0.4%. A little bit of a bid in the bond market all across the curve there. 10-year yield down by 3 basis points. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. After yesterday's record close for the S&P 500, the NASDAQ, and the NASDAQ 100, the major averages today, they are mixed right now. S&P 500 adding to its gains. It's up 12 points right now. That's up just about 0.25%. 5,108 on the, am I moving or is the camera moving? The Dow Jones Industrial Average, 14 points lower right now. The NASDAQ 100 up 93 points. That is up 0.5%. As we told you earlier, consumer sentiment falling in February for the first time in 3 months. Now, again, the major averages mixed a little change. S&P 500, 6 of the 11 major industry groups were higher. You have information technology, best performer. That's where you're going to find shares of, wait for it, yes, NVIDIA, up over 2%. Utilities right now, the biggest drag. NetApp, you mentioned that earlier, Alex. That's the best performing stock in the index. Up right now 23.2%. Data storage company boosting its outlook. And then at the bottom of the list, worst performing Xcel Energy and Las Vegas Sands. Las Vegas Sands down just about 6%. Let's do yields real quick. The 2-year falling down 5 basis points at 4.56. The 10-year yield 3 basis points lower, and that's at 4.21. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker at your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, John Tucker. Here is another big loser for you, New York Community Bank. That stock now down 21%.
Wait a second, you go from me to another loser?
Oh, that was so mean. I meant because you talked about Excel and Las Vegas Sands and Wynn. Wow, that would have been really tough. I would not be a good host. Let's go from one loser to another. Losing stock to another losing stock. New York Community Bank down 20%. All right, you know the story. It has discovered, quote, material weaknesses in how it tracks loan risks. They wrote down the value of the company it acquired years ago and replaced its leadership to help grapple with the turmoil. There was a theory that maybe this kind of risk was idiosyncratic. They are one of the big exposures to rent-controlled apartments here in New York City that has been hurt by a revamp of some of those rent control laws. So when there's a banking potential crisis, we go to one guy, Herman Chan, Bloomberg Intelligence senior analyst for U.S. regional banks. Herman, can we still call this idiosyncratic?
It is a good question. I think it's the appropriate question. What's idiosyncratic is, you mentioned the exposures to commercial real estate, specifically apartment lending and office. But what's also idiosyncratic is that it recently cleared the $100 billion asset mark, which ushers in higher capital, liquidity, regulatory issues for the bank. And what's happening in our view is that it's easy to reach the big leagues of $100 billion. It looks like it's harder to stay there, right? And what we're seeing is that they're facing growing pains in becoming such a bigger company, and these lack of material weakness in internal controls just reflects that.
Change in management, is that usually doesn't look good?
Right.
I guess that's contributing to the stock here today, but tell us about that.
Yeah, sure. So a few years back, the bank acquired another institution called Flagstar Bank, and the CEO of Flagstar Bank is now the CEO of NYCB. He was named the executive chairman earlier in February once these issues became apparent, and it looks like the former CEO just has been sidelined because of the need for new management.
Okay, so what's interesting is that if we rewind to when they were able to buy, was it Signature?
Right, correct.
Some Signature assets, right? It was like, oh, look, yay, they were the savior, etc. Is that are regulators gonna rethink what being a bank savior is in that circumstance? Like,
yeah, that's a great question. And I think it really poses a different question. Was New York Community the right bank to acquire the Signature assets and deposits? If the regulators should have known that New York Community wasn't really up to snuff, up to speed on a number of these internal issues, capital issues, liquidity issues, and reserve issues. So do the regulators need to be more cognizant of what they're doing and anointing a potential savior, and a year later, now this bank is in the crosshairs?
One of the lessons I take away from this story is, I think, a basic fundamental investing lesson, which is kind of concentration risk. Look at the company. The years have had so much exposure to this type of loan class, i.e. loans to rent-controlled apartments. that presents a whole level of risk, i.e. they're not diversified in their portfolio as much as maybe we would like. But I guess if you were an investor in NYCB, you knew that going in, right?
Yes, you knew that going in, that this was the bank that has historically focused on the rent-regulated apartment lending sector. They're the big kahuna in this niche business, and they've been doing it for decades. So that's not new. And you should have known that a few years back when New York imposed tougher rent regulations, that this was going to hurt their main business. So it's taken a few years for this to really bore itself out.
Also, maybe an investor should have known, but the company also should have known. Like, that part couldn't have come as a surprise from that end.
No, but their risk and controls, that's a real problem.
Exactly. And now they're trying to do, what is this, synthetic risk something? Like, what are they trying to do?
So basically they're
Anything
doing
with
this.
synthetic sounds not great, but
This
what do I know?
synthetic derivative transaction to help reduce their loan exposures and improve their capital. So it's one way to get rid of or improve their capital without actually selling the loans.
All right, for our listeners and viewers that are not exposed to New York rent-controlled real estate, talk to us about just the regional banks in general. What's kind of the feeling when you talk to investors today? Are they warming up to this sector? I know it's bounced off that October low.
Right.
But I'm not sure if that's a market bounce or people are saying, I think I've seen the worst in regional banks.
It's an interesting question. You're right that they've bounced, but now a number of folks in the market are saying potentially no rate cuts this year, which would be viewed as negative for the regional banks, just because deposit costs have risen.
Yeah, but no rate cuts because the economy is good and accelerating. Right. So wouldn't that be good?
There's two things that weigh on that. Number one, there's not a lot of loan growth, and rate cuts would improve loan demand. And number two, elevated interest rates is bad for credit quality and being able to refinance the existing loans, and the decline in value in areas like office commercial real estate could hamper banks' credit quality.
So where are we on that commercial real estate risk? I kind of feel like it's a time bomb still out there.
Right.
And at any time over the next 2 or 3 or 4 years, maybe multiple times over that time frame, we're going to have Bank A or group of banks that are going to call out CRE as a reason why they really missed, or they have to really up their reserves or something like that. Where are we on that?
Yeah, that continues to play out. We saw that with New York Community in the fourth quarter. We'd expect more of that going ahead in the coming quarters. That being said, the risk in our view is really relegated to the smaller banking institutions. We just looked at some data, which I think was pretty interesting. Since the COVID era, and starting in 2019, the top 25 U.S. banks have grown their commercial real estate loans by only 2%. Okay. And then the smallest banks have grown their commercial real estate by 43%. So that shows me that really the risk is comprised largely in the smaller bank cohort.
That's interesting. So let me ask a question going back to the Fed cut. So if we don't get a cut for this year, let's just pretend game out.
Did that just come with Torsten, or other people talking about it?
No, it's just Torsten, I think. I think a couple weeks ago people were talking about the worry that we may have to have another hike because inflation was reaccelerating, but this is maybe the first I've heard of no cuts at all. So if that happens and there's no cuts, who's going to be under pressure? I mean, you mentioned the fact that a cut would help loan demand. So who's already seeing sketchy loan demand?
Right. So that's an industry phenomenon where we're not seeing loan growth across the group. The Fed puts out weekly data, and it shows that loans are down, quarter to date in commercial loans. So that's a big driver of the regional bank, the large regional bank balance sheet. So that's hampered. It's going to affect banks like probably New York Community the most, because any potential rate cuts would view as a savior for them, because then their borrowers could refinance at lower rates.
All right, Herman, thanks so much for joining us. Herman Chan, Senior Analyst for the banks, joining us here in our Bloomberg Interactive Broker Studio. He's not mailing it in like most of BI management is. Here's a big redhead. WTI oil rises to $80 a barrel for the first time since November.
Yeah.
Wow. So John Tucker and I.
Speaking about a demand
not bueno.
push.
We go to
still
fill up this weekend.
under just right around 3, I'm going to say, at the Wawa.
Really?
36.
Wow.
Yeah,
Okay.
so.
I'm up 315, 320.
But I
I
think
guess that's just demand that goes to some of the economic data we're getting, suggesting that the economy is maybe stronger than expected, a la Torsten Slok, and you see it in a lot of places.
Well, also there's weirdly still a refining pull. So refining margins are not great, but they're still refining products. Like they're still buying the oil to refine them. So they're still doing that, even though the product crack spreads are not that awesome. So there is that demand pull, but that could wane. But then again, I mean, this is what OPEC wants. What was that?
Crack spread. They call it crack because you're cracking hydrocarbon molecules when you refine. Is that right?
See, you can make fun of me, but you already know the answer to this. So it's like
it was an answer with a question at the end. Is that right? That's right.
But anyway, I would agree. Definitely more of a demand story. OPEC Plus also reducing supply there. Anyway, this is Bloomberg.
Let's get some news now with Michael Barr in New York.
Thank you very much, Paul. Alex, John, there were long lines of mourners in Moscow today for the funeral of Alexei Navalny. Vladimir Putin's most prominent critic died last month under suspicious circumstances at the Arctic penal colony where he was serving a 19-year sentence. The crowd applauded and chanted Navalny, Navalny. Congress is keeping the lights on, at least for now. Lawmakers have voted to give themselves even more time to come up with an agreement on spending for the rest of the fiscal year. Bloomberg government Congress reporter Zach Cohen is in Washington.
There will be a new deadline on March 8th and March 22nd to avoid the shuttering of federal agencies as lawmakers look to finish funding agreements for a number of domestic agencies. And so there will be a new bill next week that would fund the Departments of Agriculture, Transportation, HUD, Veterans Affairs, Energy, the FDA. All of those are coming for a vote next week, and then the week after would include some of the trickier agencies, including Defense, Homeland Security, and HHS. So Congress still has its work cut out for it, especially as President Joe Biden comes to the Hill to deliver his State of the Union address next week.
Bloomberg government's Zach Cohen. Speaking of that, a White House official says President Joe Biden will advocate plans to increase taxes on the wealthy and corporations, as well as to lower prescription drug prices in his State of the Union address next week. It all begins Thursday, 8:30 p.m. Wall Street time on Bloomberg. Iowa women's basketball fans hoping to catch Caitlin Clark at home Sunday night should be prepared to shell out serious cash. Clark has a shot at breaking the NCAA's all-time scoring record currently held by former LSU guard Pistol Pete Maravich. The game could become the most expensive in women's college basketball history, some tickets selling for over $6,000. Coming up, 24 hours a day, whenever you want it, with Bloomberg News Now.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
From the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did the all in one. The idea is you pressurise the handle. The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I want it to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the Gel Razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
And the S&P NASDAQ 100, I should say, that's up 82 points right now. That is up 0.5%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. I'm Alex Steele with Paul Sweeney. This is the Bloomberg Intelligence Radio Show, where we bring you great analysis with all our Bloomberg Intelligence folks, 2,000 companies, 130 industries. You want to know about it, they cover it. We also like to give you a perspective of how to invest on a broader level, particularly on a day where the data might point to maybe we're going to get some Fed cuts, but then Torsten Slok of Apollo said you're not going to get any cuts this year because the economy is just actually accelerating. Things are too strong. So Anna Rathburn joins us now. She is CIO at CBiz Investment Advisory Services. Anna, do you agree with Torsten Slok maybe, or what's the case for no cuts at all this year?
I don't know about no cuts, but I think it's certainly difficult for the Fed to raise rates at this time, or at least looking out into 2024. And it's not just the inflation, it's their target of 2%. It has been really sticky. Sticky doesn't mean it's not falling. Sticky means it's falling very slowly and that it's very, very bumpy. So either the Fed is going to have to accept a higher than 2% inflation rate and call it maybe the momentum is heading down and start to normalize rates, or they may have to be higher for longer. That may be one cut, maybe two cuts, maybe no cuts. But I think no cuts is And that's a pretty hawkish view.
Well, he's certainly got some airtime, if nothing else, today. Anna, what do you think about this kind of soft landing scenario that seems to be out there? People kind of feel like maybe the Fed's doing a pretty good job here negotiating a soft landing. Do you buy into that?
Well, I think you have to look at the underlying risks that are in the markets. I mean, there's the labor market, weakness in the fringes that we've seen. And this is sort of like, what would a recession look like if we didn't have external shocks? If you think about the last 3 recessions that we had, they all came from crazy external shocks. How often do you have a pandemic? How often do you have a global financial crisis? Maybe there's a tech bubble. I don't know. Depends on who you ask. But that was in the late 90s. These are sort of triggered by outside factors. If you have a normal economic cycle where you really have like a natural boom and bust, you're going to see weakness around the fringes. And I think we're starting to see that, and in the consumers' labor market, as well as delinquency rates, et cetera. And you're starting to see some cracks in the markets, especially with New York Community Bank, right? I mean, that was news that came out. We started to see some cracks about a year ago. It's almost a 1-year anniversary. And here we are in 2024 talking about banks again.
So would that be a call then to sell the rally in small caps? Because what you're describing is really great for large cap companies and really bad for the small guys.
Well, I mean, I think the small caps have been telling us that it's been pretty uncertain. Because
but they've outperformed, Anna. In the short term, they have outperformed.
Yes. So short term, they've outperformed because the yields came down, right? So if we're talking about a higher for longer scenario, I mean, look at the 10-year today. It's falling pretty dramatically, and yesterday as well. I mean, small caps tend to like these things. But if we're talking about a higher for longer, we're talking about a pretty volatile rate environment where it can definitely go back up. And when it goes back up, it sort of supports that higher for longer narrative. And that's not as friendly for small stocks.
How about on the fixed income side here? I'm looking at, just the 2-year Treasury, for example. It's pulling back today off of 7 basis points. But, you're still getting north of 4.5% for a 2-year. How do you kind of advise your clients, I think, about the fixed income space?
Well, so depending on why you're investing in fixed income, I think that reason is very important. Look, I mean, yield is very, very attractive. And so even if you have some sell-off on and some headwind on the price, there's enough yield there to cushion some of that blow, so that we're not talking about the same environment as before the Fed started to raise rates, right? So we're less sensitive to price changes. So we do invest for yield, especially on the shorter end. And we are keeping duration a little bit on the shorter side because of some of the volatility that we were expecting on the longer end of the curve.
So is that a steepener trade then?
Yes, I mean, we're not.
Paul doesn't like that. He doesn't like to talk about steepeners. But because the steepener trade has been real rough.
Oh, yes, it has. And I think that's because every time the Fed comes out and says, well, we're thinking about cutting rates, we're thinking about doing this and that, I think the markets interpret that to be, okay, the Fed is going to be dovish, and the financial conditions loosen, and then it tightens again. I think it's that volatility that's very hard to stomach for some of our investors. So keeping duration a little bit on the shorter side to minimize some of that price impact is sort of our goal.
How about in the credit space here? Should I be willing to go out there and maybe take some credit risk in an effort to maybe goose up my yield here?
So we're talking about credit spreads, or are we talking about treasury yields? Because the treasury yields are very, very attractive. And of course, you put the credit spreads on top of that, it's even more attractive. But we are a little bit more careful on credit, especially on high yield. I believe our high yield is at the lowest that we're, in terms of percentage, that willing to go. It is still a very attractive yield. Again, there's some a cushion for some of the price volatility, but when high yield spread widens, that widens pretty quickly. There's a big price action there on the negative side that we don't necessarily want to participate in. So we're staying on the investment grade credit. As we all know, that market has been very, very healthy in terms of new issuance, in terms of demand. And so we are there at the moment. I can't tell you that we'll be there next month, but certainly for now, we've been clipping very nice coupon on that front.
Okay, so that's a good point, because so you're in the investment grade market, but that's for the coupon. In the Treasury market, are you there for price appreciation or are you there for the coupon?
We're there for the coupon because, again, rates are so volatile that we sort of have to ignore it as noise for the time being, and we're there to clip the coupon. So we were there for a while now, especially after, let's say, in 2023, about halfway into 2023, we increased duration, we increased our fixed income exposure to participate on that yield. And a lot of our clients are actually looking for that yield, so that made sense for us.
So, Anna, the issue here is for a lot of folks is, what is our Federal Reserve going to do? And, you know, again, there's a lot of competing calls out there, but overall, where do you think the risk profile for this market is? Do you think people are willing to take risk when you talk to your clients, or are they a little bit more risk adverse?
It's mixed. So there's definitely FOMO. But there are people who, especially small business owners, they see some of them see strengths, some of them definitely see weaknesses. And a lot of them tell us that this market doesn't make sense to them. So what is priced into the markets right now is a lot of optimism, including scenario where Fed starts to cut. And if that doesn't materialize, I think that the markets may be in for a surprise. And a lot of our clients are definitely thinking in that way. The valuations, the numbers don't sit very well with them. So certainly there's some fear, but, there's always a push and pull between FOMO and fear, right?
Yeah. I definitely have some FOMO, but I'm also like soup cans under my bed kind of gal. So Anna, thanks a lot. Really appreciate it. Anna Rathburn, CIO at CBiz Investment Advisory Services. Stock's still up by about 0.3%, buying all across the curve. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker with a look at some of your company news. And for this one, let's start off a little northeast of New York City, Darien, Connecticut. At a time when falling office values are creating turmoil, Darien, Connecticut making room for new shops, restaurants, and critically, office buildings for finance workers who got a taste of life without the commute during the pandemic. They realized they no longer want to or make the hour-long train ride into Manhattan each day. So eager to keep the top talent happy, a bunch of firms are setting up shop or expanding into the town. Take, for instance, the insurance giant Aon, the investment firm Crestwood Advisors, and Janney Montgomery Scott, all taking new office space or building it. And then you had the bond powerhouse Cantor Fitzgerald, for instance. They more than doubled the head count at the Darien outpost since before the pandemic. An investigation published by Consumer Reports says some doorbell cams sold by Amazon and other online retailers have security flaws. So they could allow bad actors to view the footage from the devices or control them completely. Researchers from the product review organization say they found major vulnerabilities in cameras that are manufactured by a Chinese company, Ekin Group. They produce video doorbells under the brand names Ekin and Tuck, among others. Amazon has given the Ekin and Tuck doorbells its coveted Amazon Choice badge. And finally, taking a cruise with the kids, maybe. MSC's new luxury cruise line Explorer, built to bring the kids. They aim to be a sophisticated solution for luxury-loving families with caviar everywhere and kid care galore. This is a company that also makes, interestingly enough, the container shippings, the containers. Maybe you put the kids there.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Friday, guys. We made it to the end of the week. I'm Alex Steele here with Paul Sweeney. You're listening to Bloomberg Intelligence, where we have all our top analysts cover 2,000 companies in 130 industries all across the world. Let's get you now to Michael Barr for world and national news. Michael.
Thank you very much, Alex, Paul, John. Funeral services have been held for Russian opposition leader Alexei Navalny under a heavy police presence in Moscow. Bloomberg's Henry Mayer covers the Russian government from Dubai and has more.
Large numbers of Russians came out to pay their final respects, certainly thousands, and they waited for a long time, several hours outside the church in southeastern Moscow, where a funeral service was held. And the funeral service didn't last very long. Only the family was allowed in. So all of these people who had been waiting for this long period of time were not actually able to enter. They then made their way to the cemetery.
Bloomberg's Henry Mayer reports riot police were stationed throughout. The Kremlin had threatened punishment for any unsanctioned gatherings. Images from the Texas Panhandle show a surreal landscape charred by wildfires as the Smokehouse Creek fire has devoured more than 1 million acres. At least 2 are dead. Homes and other structures have been burned, and the loss of livestock is hard to calculate in one of the largest beef-producing areas in the nation. This Fritch, Texas resident was overcome by the destruction.
It's heartbreaking, not just for me and my family, but all the other families that have lost.
The Smokehouse Creek fire is still burning. It is the largest wildfire in Texas history and the second largest in U.S. history. A dangerous storm is on its way to California's winter resort region, bringing life-threatening conditions and a potential to dump more than 12 feet of snow. This truck driver was about to get back on the highways around Sierra.
I don't like that they got checkpoints for chains, like let people get on their way if we know how to drive. If you don't know how to drive, get off the road.
Wind gusts in some areas can hit up to 70 miles an hour. Global news 24 hours a day, whenever you want it. Bloomberg News Now, I'm Michael Barr. This is Bloomberg. Alex, Paul, John.
All right, let's talk about some breaking news here. Stocks on the move. Boeing stock is down 1.6%. Spirit Aerospace Systems is halted. This comes as a Wall Street Journal report says that Boeing is in talks to acquire Spirit Aerosystems. Remember, Spirit Aerosystems is the jet fuel supplier, so they make the engines and stuff, the jet fuselage supplier. It split off from Boeing 20 years ago, but they're responsible for a lot of the quality issues for the 737 MAX jets. They also supply stuff to Airbus. It's not like they only supply Boeing, but Boeing cannot let Spirit Aerospace fail because they have nowhere else to get the stuff, but buying it seems crazy after 2 decades.
It seems crazy, but you know what? Just not knowing anything about this industry, they need to do something just bold here if you're Boeing. You cannot have the existing situation continue at all because there are obviously some quality problems throughout their processes, which they've already admitted. And if they are, in fact, at Spirit, which a lot of people feel like a lot of those problems are at Spirit, you need to take control here, I think.
But I wonder, like, but would that solve all the problems? Because part of the reason why Spirit Aerospace maybe had some quality issues is because Boeing also pushed them really hard to deliver stuff and be cost effective for Boeing, which wound up hurting Spirit Aerospace in the meantime. So you kind of like, in some ways, it was of your own making. I guess from that point of view, now you got to take responsibility in some respect. This would be huge, though. I'd have to say this would be a big deal.
Yeah. So Spirit Aerosystems, as Alex reported, the stock is up 5.8% today. Trading is halted. So we'll see how that plays out here. But again, it would be big news there. And Boeing really, you know, as we've said all along, and George Ferguson, who covers Boeing and the aerospace for Bloomberg Intelligence, has told us, you know, this is you can't have any reputational issues in this business because you've got to be perfect.
Yeah.
I mean, you know.
And I think what we also learn on this is that either way, Spirit Aerosystems is in deep trouble. And the journal is saying that they've hired bankers to explore options. So even if it's not Boeing, like, they clearly need to do something, and they're in a really stressful economic point. But yeah, I think like having a door blown off is not awesome. Like, you don't want that.
No,
that's something that's you don't want in your life. Okay, so Boeing stock is down by 1.8%. Spirit Aerospace jumping all over the place. A pause for trading as well. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Joanne Shu, University of Michigan. They were out there, UMich data coming out today, kind of weaker than expected. We're going to break that down with Joanne Shu. Then we did find George Ferguson. He covers the aerospace area for Bloomberg Intelligence. He's going to come on in this hour and talks about what's happening with Boeing and Spirit. Again, potentially, according to the Wall Street Journal, potentially some discussion between those two companies. It is Friday, which means we talk municipal bonds. You've been waiting all week for it. Alex, we're going to bring in Eric Kazatsky. He does all the muni stuff for Bloomberg Intelligence. And there's also a cool story out there. Truist, the Southeast Regional Bank, they're hiring a lot of the bankers, municipal bankers at Citi let go.
Oh, that's interesting.
When Citi, for some reason, I don't know, I guess, got out of the municipal bond business. Just crazy. All right, so that's all coming up this hour. But first, let's go to John Tucker and get a Bloomberg Business One.
All right, we're looking green on the screen right now. The S&P 500 continues to push higher. Yesterday, of course, the S&P 500 notched its 14th record this year. NASDAQ and NASDAQ 100 also closed at all-time highs. A decline in consumer sentiment. You just talked about there, Paul, solidifying bets on interest rate cuts. You also throw into the mix Federal Reserve Governor Chris Waller saying he would like the central bank to boost its share of short-term treasuries. So that is sending yields lower right now. Goldman Sachs chief global equity strategist Peter Oppenheimer, he was on the air on Bloomberg earlier today. He thinks stocks can push higher still.
Seen this very powerful rally, but it's come from a position where investors were quite worried about recession and inflation. Those fears are receding, and as long as the earnings continue to grow, we can see, I think, some upside to equities and better returns than in other major asset classes.
S&P 500 20 points higher. That's up 0.4%, 5,116 on the index. The Dow Jones Industrial Average up 43 points. The NASDAQ 100 up 123 points. This is a rise right now of 0.7%. Quick check of Boeing shares down 1.6%. U.S. crude prices hitting $80 for the first time in almost 4 months. NYMEX crude up 2.6%, $80.34 a barrel. And we check markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. And just a quick update here. Boeing stock is down by almost 2%. Spirit Aerospace is now trading again. It's up by about 18%. This comes as a journal article says that Boeing is in talks to buy Spirit Aerospace. They also say that Spirit has hired bankers to explore options. We will keep you updated on that. George Ferguson joining us in just a second. In the meantime, let's get some more market movers here with Nora Melinda. She joins us in studio. All right, Nora, what you got? You were looking at what, ADM?
Yes, Archer Daniels Midland. That's an agricultural trader, but it's really up a little bit right now. It delayed the publication of its annual report and warned that it anticipates reporting, quote, material weakness in the company's internal financial reporting practices. It feels like that's really the phrase of today when we think about NYCB as well. But investors did take a sigh of relief after it indicated that there won't be a broad impact on its overall earnings. We have shares rising as much as 3.1%. And this is the first update that ADM has really given since its shocking January announcement that it was placing its CEO Vikram Luthar on administrative leave pending an internal probe. So really interesting here.
All right, yeah, I mean, it's been a really tough time for ADM. They're going to have very limited visibility for a very long time. There's only a handful of these guys, so I have one of them struggling. It's interesting in what it does to the other parts of the industry. All right, you're also looking at Palo Alto Networks. What you got there?
Yes, so we have those shares tumbling a bit, as much as 4.4%. Now, this company is getting hit with a class action lawsuit. The people are alleging that it misled investors with claims that new AI products were, quote, facilitating greater platformization. And it prompted a 28% sell-off, but these investors really do feel a little bit deceived about the traction of its platform tactics and hurt by an unexpectedly low billings forecast from the company that did end up crashing the share price.
It's tough when investors are hurt.
Yes.
When they're hurt, I mean, that always hurts them. How do you feel, investors?
Exactly. Right. All right, Xcel Energy, XEL is the ticker.
Yes, XEL. Those shares are down as much as 7%. Now, this is the lowest intraday level since 2020, and this comes after, unfortunately, the worst Texas wildfire in history that wiped out both ranches and cattle.
This is brutal.
It is really bad. I believe at least one person died due to the blaze. But this is kind of coming back on Xcel Energy specifically because a law firm that disclosed that it may be responsible for the damages. They're still trying to get to the bottom of what sparked this fire, and Xcel is saying that it will cooperate with investigations as they try to progress on this, but the news actually made the stock drop and erase about $1.9 billion of its market cap.
We've seen this play out PG&E, San Francisco. We've seen Hawaiian Electric. What happened in Hawaii? Like, we've seen this story play. Nothing confirmed, but like this has been somewhat of a playbook. All right, Nora, thanks a lot. Nora Melinda joining us there from Bloomberg. Let's get back to some of the eco data at the top of the 10. University of Michigan sentiment, the final read for February coming in a bit lighter. Current conditions revised lower as well, and expectations revised lower as well. We want to get to the bottom of it. Joanne Shu, University of Michigan Surveys of Consumers Director, joins us now. The revision lower, Joanne, what happened there?
Essentially it edged down just a little bit. It was not much of a change at all. And essentially we should interpret this as moving sideways between January and February. Essentially, consumers haven't really noticed any material changes in the state of the economy since the start of the year. And that comes through in our data. At the same time, it's also solidifying the really enormous gains that we saw in December and January. We're still almost 30% above where we were in November. That hasn't really changed even with this little wiggle this month. So consumers feeling better than last fall, feeling about the same as last month.
Yeah, I guess a lot of folks, Joanne, right now, given some of the inflation data we saw in January, CPI and PPI and so on, maybe concerned that maybe inflation's coming back into this economy. Are you seeing that in any of your survey work?
No, consumers broadly have felt pretty assured that the slowdown in inflation is going to continue. The data that these new inflation numbers came from reflects consumers' experiences last month. It comes in at a lag, so consumers already notice those prices around them and any changes in prices. Last year we were seeing quite a bit of volatility, seesawing in inflation expectations in January and February, exactly the same.
So Joanne, what are we going to be looking for the preliminary read then for March? Like, what are going to be like the standouts that you're looking at?
The main thing we want to look for in the months ahead is whether this 30% gain that we saw in December and January, whether that's actually going to stick, given how dramatic those increases were. So far, the February read confirmed that. Let's see if that stays put in March and April. And as mentioned, inflation expectations absolutely top of mind for consumers.
All right, very good. Hey, Joanne, thanks so much for joining us. Really appreciate it. Joanne Shu, Surveys of Consumers Director there at the University of Michigan. We had some data come out there today. Again, M&A talk just kind of coming across the tape here. Boeing in talks to buy supplier Spirit Aerosystems. Spirit Aerosystems stock is higher, Boeing a little bit lower here. But one could argue this is a transaction that probably needs to happen for Boeing to address some of their concerns. Well, let's bring on George Ferguson. George Ferguson covers the aerospace and airlines business for Bloomberg Intelligence. George, tell us why Boeing would want to do this transaction.
Good morning, Paul. Quality control. It's absolutely quality control. They must be looking inside Spirit. I know they've been looking inside Spirit for months. My guess is they've looked inside and they just feel like they can't control quality well enough. As an outsider, they used to own Spirit, not as it looks exactly now, but they used to own, those facilities. It makes a majority of the 737 fuselage. It makes the front portion of the 787, two extremely important products. I think they've looked inside and they said, we can't control quality well enough from the outside. We got to buy this thing.
Do we trust Boeing to have the kind of quality control that Spirit needs?
Boeing doesn't have a choice. Boeing's got to get quality control or they got a major problem on their hands. And so I think as an owner, I think it is the path, probably a good path forward. I do think they will get the quality issues in hand, but it's going to take some time. But they have to. They have no choice.
Yeah, I'm looking at the stock of Boeing, pretty much unchanged on the news here. If I were an investor in Boeing, I would think it may or may not make financial sense to own this Spirit thing, but I would say it's probably the best way to move forward here. And when you talk to investors, George, did they think that way?
I think investors, I don't know that you could say they all monolithically think that way. I think if there could have been a way to keep it outside, not have to buy it, I think that probably would have pleased people more. I mean, there will be an unwinding required in this transaction, right? So Airbus's A320, some of the components are made at Spirit. I'm imagining that Airbus is not going to be interested in having, Boeing as a subcontractor on their airplane. And there are other defense products, for Lockheed and things like that. It's going to require some work to unwind this thing a little bit. In order to pull it inside of Boeing, probably energy you would prefer not Boeing to spend. But again, I think it's their most important products are flowing through Spirit, and Spirit's been a source of the problems in some of those products lately. And if Boeing is going to much higher production rates, which is where they're going to generate the cash flow they need, the profitability they need, they've got to stabilize production. And I think they must have looked at it and said, we got to own it. And so if you're an investor, I think you're, okay, yeah, it's the way forward. I'd rather not have taken this path, but it's the way forward.
This is a leading question, and it could be very wrong. But does this tell us anything about how bad things are at Spirit, that this is the option?
I think it does.
So how bad are things at Spirit?
To me, it sounds like it's so bad they got to buy it. And I think that's bad, right? If you're Boeing, you do want to preserve cash, right? You don't want to go make an acquisition. You got plenty of other things to manage right now. But I think it means that, yes, the turnover at Spirit's been bad. The quality control, I think that's led to the quality control problems. You want to have your hand in how those line workers are being managed, how the quality control is being handled. I think it means it was really bad at Spirit.
All right, the shares of Spirit Aerosystems, SPR is the ticker for your Bloomberg terminal, up 14% year-to-date. Trading has resumed here. So obviously the market signing pretty high probability that something will get done here. So George, just looking at Boeing holistically, you know, as you've told us in the past, you know, this is a scale business. You got to make as many planes as you can for that over that fixed cost base you have. Talk to us about the production goals, or talk to us where they are in production today and where do they want to get to? And do you think that's a reasonable glide path?
So they are at 38 today, although they'll tell you, even though their suppliers are building at 38 and delivering to Boeing at 38, Boeing's not putting 38 out. So I don't know, they're somewhere between, they're somewhere in the high 30s, let's say, depends what month it is.
That's on a per month basis, just in general.
Sorry, and that's on the 737.
Yep.
That's their most important product. On the 787, you know, we're in the I think 5-6-ish area right now. On 737, you know, they've got goals to be into the 50s. They've and at the end of the last expansion phase before the pandemic, before the MAX crashes and groundings, you know, they were in the 60s. They're not going to go to the 60s. Airbus is, you know, for the 737, Airbus is talking about going to 75 for the A320. So I think if you and I were inside the Boeing management meetings and they told you where they really wanted to go, they want to be up there near Airbus, you know, taking a 50-50 complement of this market. Is that the right place to go? Yes. They're talking mid-decade. Yes. Probably pulling Spirit inside. Timing probably had a lot to do with that too. They thought, look, how can we stabilize this the fastest? Because we don't want to keep giving away share to Airbus.
Going to Spirit, back to Spirit just for 1 second, we're also reporting that Spirit is exploring strategic options. So that leads me to believe that if the Boeing thing doesn't happen, they're still in deep trouble and they got to get a buyer or do something else. What would be plan B?
For Spirit?
Yeah.
Yeah, I mean, when we look at Spirit's, you know, Spirit has a bunch of debt coming due. The capital markets haven't loved them as much. I think you know, that some of the debt they've placed has been up in the 9%-ish levels. I think the capital markets, the debt capital markets especially, have looked at the Boeing relationship, and that's given them more comfort, probably to give them rates that perhaps were better than what Spirit should have got. I think it, frankly, would be strategic options, you know, away from Boeing are really difficult because, again, some 50, 60, I'm talking off the cuff here, I'd have to go pull the exact number of their revenues flow through Boeing. What I'm guessing, and that strategic comment, is that Spirit is probably looking at how they would spin off portions of the business that are not Boeing focused, so that it could continue, you know, to serve those customers. Like I said, Airbus, Lockheed, other defense companies have products that are being built by Spirit. I think they're probably looking at ways to continue to service them in an entity that would be outside of Boeing. You know, the fuselage building business, which is largely what Spirit does, isn't one of the great money makers in the industry. And, you know, we've seen it go to some, you know, to go offshore. You know, the Koreans want to be in this business. The Japanese are in this business. The Chinese are in this business. There's a lot of competition in that space. And so I think it makes it a really hard part of the business to be in to make very good returns. And look, it's a space, the fuselage building space, that I think Airbus has kept more inside because, again, they want to control the quality. So, you know, I guess that's a long way of saying I don't know that options as a complete entity away from Boeing, I don't know that great ones exist, and I don't see that. My guess is they're trying to spin parts of it away.
All right, George, thanks so much for joining us on short notice. Really appreciate it. George Ferguson, he covers the aerospace business as well as the airlines, the whole complex over there, including the defense manufacturers. Again, Wall Street Journal first reported, now Bloomberg News matching that Boeing is in talks to acquire Spirit Aerosystems Holdings. SPR is the ticker. Spirit the stock is up 15.5% today, right now. So suggesting that the market believes that there is something there. And as George was suggesting, Alex, it's probably something they got to do.
George was awesome.
Yeah.
Like, that was
It's not bad.
great. That was
Yeah.
great perspective, etc. Yeah, and I thought that it was really interesting that it's the fuselage business. So if you can spin off other stuff, maybe that's the profitable moneymaker. You can still keep the contracts with Airbus and Boeing, but it's the fuselage business. Like, that's the part that Boeing just has to basically absorb and suck up within its company. We'll see if that works. You got Spirit Aerospace Systems is up by 16% right now. Boeing is down by about 0.6%. A big potential deal in the